All right, good morning. Are you ready for today's session? Okay, first of all, I would like to thank everyone and welcome to the MIA-ACCA 16th Train the Trainers. Okay, um, my name is Hasmida Ismail, all right, from the Malaysia Staff Accountant. Ada tak yang tak kenal saya? Maybe kenal through the email, right? So this is our first session. I think we held the Train the Trainers at the KK itself. So very thank to everyone for your support, and I'm quite surprised to see at least 40 lecturers for today. It's a huge number for us, okay? Because we also doubt whether we can get the numbers from KK, but I think it's a good numbers, and alhamdulillah. All right, for today, I will share a little bit about the membership, okay, before we start the session, okay? Hope you all okay? Okay, how many here is an MIA member? Okay, meaning that I think half are still not members. So maybe for today, I share a little bit of information for those who are still not apply and intend to apply. So at least to benefit all of you. All right, basically for MIA, if you're aware that we have two membership categories. Firstly is a chartered accountant. Second is the associate member, okay? So for the chartered accountant, we know that this is for those with the experience, who have the industry experience, who have been worked in the industry previously. All right, so for those, and the second membership category is associate member, okay? For associate member is for those who only have the teaching experience. This is a special category for the academicians. So meaning that everyone for you, meaning that if let's say you don't have tak pernah ada experience previously, or that experience is a very long time ago, so you can still apply to be MIA member under the associate member category. So this is just for information on the statistic membership as of the March 2025. So we have about 40,000 of members, close to 41,000. And then members in academia, we have about 2%, okay? So majority of members for sure under the commerce and industry. Okay, this is the pathway for information how to become the MIA member. So firstly is this is the three pathway that we have, all right? First is for those who are graduate under the part 1. University recognized under MIA. Currently, we have 21 universities. UMS part of also be recognized. UITM, of course. Okay, this is part of that. And I think for the polytechnic, if let's say for information of your graduate, so upon completion of the diploma, they have to pursue the degree in accounting for recognized university for them to apply for the chartered accountant category. But later on, maybe I can share a good news for you under the MIA competency framework. This is something new for the diploma graduates. So first is those who are graduate from the recognized university. Once they complete the degree program, they need to gain the 3 years work experience. That will be under the CARE program to monitor the relevant experience before they can register as chartered accountant. Second is those with the professional qualification. This is also applied for the associate member, for the lecturers. If let's say you have the membership from any of the professional qualification recognized by MIA under part 2, okay? If you are full members and you can apply as chartered accountant, regardless you are teaching, but if you are full members, you can register as chartered accountant, all right? I think we have a few pathways that will provide for the academician. If let's say you're taking the CIMA qualification, and then the pathway for them to register as the chartered accountant as well. I hope you can explore this kind of thing because they provide a special pathway for the lecturers. And last one is for overseas graduate or any university degree is not recognized under part 1 or qualification is not recognized under part 2, they can become chartered accountant through the MIA qualifying exam. So meaning that they have to complete the MIA qualifying exam first. There are 4 papers. Then they have to undergo the CARE program to record the 3 years experience, then to register as chartered accountant. Clear for that? Okay. All right. Next is this is the list of the university. Okay, currently have been recognized under MIA. There are 21. Okay. The new one are included, I think, in 2024 AGM, we have recognized UTM, UNIMAS, OPSI, and TAR UMT. TAR UMT, last time they called us TAR UC, okay? All right, next slide is, this is the list of professional bodies recognized under MIA, okay? If you are any one of the members of the professional body, can register as chartered accountant. This is just some overview about the MIA qualifier exam, which is, I said, there is an alternative pathway for those who are not recognized under Part 1 or Part 2. So if they are doing the training program, but the requirement is they need to have the 60% of accounting qualification in order for them to become to register for QE. All right, this is special for the associate member. I will email to you as well for information. So how to apply as associate member? So this is the pathway, all right, for those who have the first degree or master degree. Meaning that if you have your qualification in degree is not recognized, I believe ramai lecturers actually overseas graduate again. And then if let's say you have a degree not recognized under Part 1, but you have master in accounting, you're still eligible to apply as associate member. So if your first degree, a master or higher, and then you have at least 3 years teaching experience, you're eligible to apply for associate member, okay? So for you to register, you can, anyone tak pernah tengok this MIA website, members portal. For the members, I believe that you have, right? So this portal is not only for MIA members. Even if you are not members, you still can register, because for any training, you must go through the MIA portal, all right? So you can register first, and then this is the record. So there is a form actually under the website. They provided, they call as record of teaching experience. So this is of the requirement, okay? So this is how actually the form look like. So you need to fill up the relevant experience on the teaching, which subject you are, and then you have to submit to your superior or maybe the dean or head of department for them to verify, and then you can submit for the membership application. This is very simple, okay? All right, clear on the membership pathway? Okay, next I want to share about the upcoming event by MIA. So, are you heard about the NAEC previously, the National Accounting Educators Convention? This is the convention that we do specifically for the lecturers. I think we had in last 2 years, perhaps. Last year we don't organize. So this year we are coming back. So the event will be in June. All right, it's a physical event on 24 and 25. And then there also will be a special rate for group registration. I think most of you perhaps have received the email as well from us. Okay, so do take this opportunity for you to attend the session. And then the next event that we will organize as well on the Train the Trainers on the taxation. This is a webinar, will be held on 15. So this round we will be covering topic e-invoicing and also the ESG for the green technology. So for those who have registered, thank you very much. We have received about 100 plus registration. And for those who yet to register and perhaps you don't receive any email, so you can reach to me just now. I will share with you for the registration. All right, okay. The next update from MIA on the MIA sensibility. We know that accessibility is a new topic coming in, and even for the Hala 7 also, I think there are something that will be appended, and currently is still yet to be introduced, am I right? Because still new. And if you're aware also under the International Education Standard, okay, IFAC has revised the IESS, and then they embed into a few IESS on the sensibility, all right? MIA also will be sharing an update on that, and additional to that, part of MIA initiative, we also have the blueprint, okay, we call as accessibility blueprint, which is we has established and also now available on our website. So you can look into the blueprint and you can look into the section whereby applicable to you, and also it's a good awareness for you to know on the industry part as well. So along the way for that, currently MIA initiative, we will conduct a survey. We will share later on with all the universities for us to know and to understand the requirement for university. For example, the university have been covered on the topic, and then what kind of support you like for MIA, for example, in terms of the resources, in terms of the teaching materials, so on, what kind of support, and to what extent you have to introduce to the students, and the preparation of lecturers itself on the sensibility. So we will, inshallah, we will launch the survey by June. I make sure I will send with the head of department and also to the dean of the faculty, as well as the lecturers, for you to respond. Based on that study, we can know actually what kind of support for MIA to support our university. And this is not only for the degree program, it's also applicable for the diploma program as well, because the sensibility is not only at a higher level, they will go all to level as well. All right, so to look into the sensibility blueprint, and then on top of that, okay, for the sensibility as well, if let's say for the lecturers who would like to have the talk, for example, for you to give an awareness for the students, you can reach to MIA as well. So at least we know the support we need. And then I think last year in November, we had one event, the physical event with SIMA on the sensibility, but we had in KL, so we are not inviting those who are in Sabah, Sarawak, because I think it's quite far away, only when the event. But the video we have uploaded at the MIA YouTube. So if you're aware that we have a few video uploaded on the Train and Trainers and also in advocacy. So you can look into the MIA YouTube to look into relevant videos for the teaching and learning purposes, all right? So this is how we try to benefit those who are unable to attend the session, all right? So you can look into the MIA YouTube. Similar for today's event also, that will be uploaded at the MIA YouTube. All right, so once it's ready, we will share, and then you can share with the student as well for them to learn from the video, okay? All right, so stay connected with the MIA. We have a few channels actually. So even advocacy or any updates, they will be at the MIA website. They're also at the MIA Facebook as well as LinkedIn. Okay, are you ready for the next session? Maybe just a little bit update. We will have a morning break by 10:30. And then after morning break, we have a session with ACCA. ACCA representative also coming here today. We will share a little bit update. And then we will stop for lunch by 12, because you know that today is Friday. And we will start afternoon session by 1:30. All right? Okay. Okay. So without further ado, I would like to introduce our speaker for today, Mr. Selvarajah. I think everyone's quite familiar with him, right? Ada pernah tak pernah jumpa? Siapa sini is the first time for you to attend Mr. Selvarajah session? Oh, ramai. Even the webinar we had also tak pernah attend? Tak pernah? Alright. So I think for your first session, definitely you will love him. Okay. So today we will be covering about MFRS 18, all right? I think this is a new standard that have been issued in 2024, and the implementation will be in 2027. So please do take your opportunity, all right, to ask Mr. Selva, and do participate as well, because there will be case study discussion as well. And then Mr. Selva is someone that's very experienced, having the industry experience for quite some long, and also actively become a speaker, especially on the MFRS. So to take the opportunity, all right? And if let's say you have any question, I'll be sitting there, all right? So Mr. Selva?
If it's too soft, can you hear me? I can hear me because the speaker is behind me. So I don't know whether you can hear me. So I thought I'm speaking very loud because the speaker is here right into my ears. Okay, anyway, let me just put, my screen is on. So today we are going to look at a standard, which is, as you have already been told just now, that it is a new standard, MFRS 18, to replace the MFRS 101, relating to presentation of financial statements, how do you show all the amounts in the accounts. So there's going to be a slight change in the method of presentation, because don't forget, MFRS 101 is an old standard. When I say old, in the language of accounting today, anything that's more than 5 or 6 years old is considered old, because the scenario is changing a lot, all right, in terms of the the needs of the stakeholders, the various stakeholders who use the financial statement, be it the bankers for the purpose of facility, or whether it is the shareholders, new shareholders who want to come in, fund managers, creditors, and even those who want to subscribe for preference shares, etc. All of them are stakeholders one way or another. So they like to know about the company. So the only way to look at the company is to look at the figures in the balance sheet and profit and loss account. Now the thing is that the old standard at that time was suitable then. But nowadays people have become more sophisticated. They want to know more details, or rather able to analyze it more accurately than what is shown in the previous account. There was a possibility, or there is a possibility in the existing MFRS 101 to present the accounts in a slightly tweaked fashion to the advantage of the company. To a certain extent, yes. So we will learn all that today. And so therefore, to overcome all of this, the standard was revamped. That's why you see IFRS and MFRS over the last how many years since they were first launched, in 2005. 2005, they were launched in the world, IFRS. And then it came to Malaysia, and then we actually officially adopted it in 2012, if you remember, where the Malaysian Accounting Standards Board adopted this as a definitive standard. So then, of course, from then on until now, all right, there are many of the old standards that have been withdrawn, replaced with new one. There are a lot more new standards that did not exist before and which have come into force now. Why is that so? Because of the demand of the users of the financial statement. They are no longer satisfied with just a basic set of accounts. They want more information, more detailed information, or a summary which they can work on, and the summary will not be adjusted. All right. So, for instance, if you wanted to put an unusual item in the accounts, all right, you could show it in a number of ways. So sometimes you can hide it. So sometimes you can show it. Then comes the question, what is unusual item? What really is unusual? So we will try to examine things like this today. All right, so along the way, when you have questions, of course, I no need to tell you, you can just raise your hands and ask them. So we'll make it an interactive if possible. This is the main thing today that we are going to go through. Now, before I go through, I want to give you a summary, which I think is also on your slide, one of your notes there, a summary of the whole program for today in a slide form. All right, so these are the very important things that we need to look at for today's the main points on here. So this replaces the MFRS 101, is effective for the year 1st January 2027. Now, although we may see that 2027 looks like quite far away, it's not really, because you need to also do some restatement of the figures. So, and in terms of teaching the students, they have to be aware of what is coming, because that when they come out to work or when they are ready, they will be actually facing this new standard and the old one becomes a part of history. So that's why we want to see, it aims to enhance the communication of what is financial performance. So where is financial performance coming from? The profit or loss, all right? So the balance sheet is actually a statement of balances at a particular time, so the financial position. So the financial performance is the most important. So people want to know, you have all these assets on the balance sheet and the liabilities. What are you actually generating from them? Many a time you find people having assets on the assets on the balance sheet, liabilities on the balance sheet, a lot of standards have already addressed the shortcomings of the asset and the liabilities. For example, if you look at any assets, when an investor is putting money into the company, he wants to see what is he putting the money for. What are the assets? Are they generating income? Now, many times companies have assets there, and in real life, the assets are just idle. So let's say in a factory, you have 5 pieces of machinery, each one say about 10 million. All right, so you got 50 million worth of machinery there, and let's say all of them is already at about 50% depreciation. So assuming they are being depreciated for 10 years, so out of the 50 million, you probably have 25 million on the assets on the balance sheet. But in reality, when you go down to the ground, maybe 2 machines two machines are already obsolete and old, and they are not functioning well, or they are taking up too much power, and therefore they are unproductive, or their production units are very low. So the company may have put them aside, and they have already now have the balance of the machine. But what we are seeing on the balance sheet is all the 10 machine, 25 million balance on the machine, and the profit shown in the P&L account is a certain amount. So if somebody wants to test and see, is the company earning, right, properly on the asset? I mean, return on assets employed. So you are actually looking at your return against the 25 million. But in reality, the 25 million is not producing the income. 2 of them have already been abandoned. So what would you do? You leave it there until it's sold, or wait until somebody comes and buy for scrap, or maybe the directors may say, oh, let's leave it there first. In case our production increase, we might want to use it. So in the meanwhile, depreciation is going in the accounts. Balance is falling. Profit is falling, right? Assets are increased. So a reduced profit is tested against an increased amount of asset. So what will people say? Hey, this one, the assets are not efficiently used. Using so much of assets, but the return is no good. Another company are much better. So you see, you get an erroneous problem here. So how did they correct it then? Then they brought in this, impairment. So then again, the next question was, how do you calculate impairment? All right, so there are 2 ways of calculating impairment. One is, what is the residual value? What can you sell it on the scrap market? Get some scrap dealers to give a quotation. All right? Or you can say, all right, another way is value in use. Suppose I am going to continue to use this machine until the end of its useful life. How much can I actually get from it? Since the machine has got a 5 million balance on the account because the 10 million machine, so half already depreciated, so I got 5 million. So can I get 5 million worth of production to cover it? So you might find that, no, I only can get about 3 million. So in the end, you'll discover that you have to do an impairment of 2 million, all right, on the value in use base. So all these methods have already been incorporated on the balance sheet through the various standards to try and bring the balance sheet in line. So another standard that you might also have come across, those assets that are no longer used have to be taken out from the balance sheet, right, and put into assets held for sale with the corresponding liability if there is. So what does that do? It takes out this 2 machinery and puts it on the balance sheet as a separate item. The condition of this asset held for sale, depreciation stops. So when depreciation stops, what happens? Profit goes up. Your machine is still there. And then when you test it against the assets employed, the asset employed is only the remaining machine. So suddenly the same scenario has got a different result. Right? So you see, this is what the financial reporting is all about, to show the true result on the balance sheet. Now, by the same token, they are doing that to the P&L account now. All right, a P&L account was not really addressed previously in as much as it should have been, other than the conceptual framework which sets out what are the assets, what are the liabilities. I'm sure you're aware of that. And so anything that does not fall in the category of an asset on the balance sheet has to end up in the P&L account. In other words, the P&L is the tong sampah. All right, everything goes there. So now, having said that, then there are also some shortcomings in the presentation of the P&L. So that's why they had to do this to enhance the communication of that profit, the financial performance. All right. It also introduces operating profit subtotals and management, designated performance management, matrices. How you're going to determine what as management saying is a performance of the company. So that's called the MPM. And then disaggregation and consistency. Sometimes people like to hide in a grouping. That's called aggregation of balances. So in a grouping, in a P&L, you can aggregate. So I don't know what unusual or what items are inside there. They are all aggregated. Looks all very nice. So now the standard now requires us to break it up, disaggregate where it is relevant to disaggregate. So we will also look at what needs to be disaggregated. And after that, you must be consistent in your disaggregation. You cannot say, this one I want to do, that one I don't want to do. All right? Also, there are mandatory categories in the P&L now, in the Statement of Financial Performance. Categories like operating, investing, financing. What does it remind us of? It reminds us of the cash flow statement, where you got investment in, cash flow for investing activity and cash flow for operating. So this is going somewhere along that lines, trying to harmonize the two. And then the taxes and the discontinued operation. Now, there was already a section on discontinued operation. This one enhances it. Discontinued operations are different from assets no longer in use. So sometimes you have an operation that a company may have many operations or many outlets. They discontinue certain ones. So how do you show these discontinued operations, whether they are making a profit or a loss? All right, so that is sometimes hidden in the main profit. So we are going to look at that as well. There are also required subtotals like operating profit. Last time there is gross profit or no profit or nothing. All right, sales, less, expenditure, and then you carry on like that. So now you want operating. So again, definition. What is operating profit? So we will look at that as well. And then classification of income and expenses is very critical. Because if you don't classify them in the right category, you could hide them. You could hide. We'll see some example. And then presentation is by function or by nature. We all know that function means you group all the accounts together. For instance, if you're talking about sales, you talk about salesman salary, salesman commission, then sales traveling, all those things relating to sales are called, when you put in the P&L, they are called by nature. That means you identify each item that really clutters the profit and loss account. So in most companies today, they use the by function. They group it together. So sales and administrative expenses or sales expenses, which groups everything inside one item. Administrative, one item. So when you put like that, the P&L is easier to see. All right, but then what goes inside there is another story. So this one, function or nature, what are the shortcomings and how we're going to address it. Now, balance sheet or cash flow, there is no structural changes as it were. It is still the same. All right, balance sheet structurally is still the same because it's already been adjusted over many standards. The cash flow is the same except for a slight tweaking in the cash flow that we will see. So it also reinforces on the balance sheet and the cash flow a clear disaggregation and label clarity. That means don't group and hide it. A clear disaggregation when necessary. All right? Also, consistency between the P&L and the cash flow. If P&L is investing, cash flow cannot be something else. So it must be something like, cash flow must be investing, the P&L also must be something to do with investing. So there must be consistency. All right? And it is always based on the primary document, which is the cash flow statement. So from there, you also decide on the P&L. Not the P&L decides the cash flow. Cash flow decides the P&L. All right? So this is the management defined performance measures, which is called the MPM, management defined performance measure. So management has defined what is the performance measure. All right, so that's called the MPMs. It's the new term introduced in this new MFRS 18. So what is their management's view of performance? Their performance measure is how they determine their view of the performance. It requires a reconciliation to the IFRS or the MFRS defined subtotal. So when the directors decide to define something or management defines something, it cannot be inconsistent with the IFRS or MFRS. If there is an inconsistency, you must reconcile in the note. Otherwise, we say, how come like this and like that? So you need some. So the disclosure must include the rationale, why, the consistency, and the reconciliation. You cannot do cherry picking. This one I like to show because it's a good profit. This one is not so good, it's a loss. I hide it inside. That's called cherry picking and misleading metrics. All right, so we will look at some examples afterwards. Then for enhanced disclosure and presentation, disaggregate material line items. So again, the question is, what is material? I think you know very well there is already a new definition of material where materiality relates to if the user of the financial statement comes up to a different conclusion. Had he known about that item, then that's material, right? If he comes up with the same conclusion, had he known about an item, then that's called not material. Now, that's not really very helpful in real life practice because you can still interpret, all right? How do you know the user of the financial statement, what is he thinking? We don't know. We assume we know what he thinks. So there's a little bit of flaw in the standard setter when they put what the user will feel. Two different users may feel different. But anyway, that's materiality. So that's what we need to do, material line items. Unusual items, significant in nature or in size, not necessarily non-recurring. Usually when you say unusual, it means once it will occur, it may not occur again. All right, so it's not necessarily non-recurring. Some of the unusual items can, for certain circumstances, be recurring. And we will see one or two examples of this to get an idea why it is like that, right? And then present the expenses by nature or function consistently. Align the classification of the interest and dividends in the P&L and the cash flow. Where is the interest coming from? Or where is the interest being paid for? What is shown in the cash flow, the same meaning must be there, all right? And then, of course, there is a retrospective application of this. You need to reclassify. Excuse me. You need to reclassify the expenditure for the previous year because you can't show the new classification this year without having comparative. So you need to show that there are some exemptions, but very little exceptions, all right? Key challenges of the systems. If you are using, automated systems to generate the profit and loss account in companies, they need to realign the system to pick up the right figures to put in the new format, all right? And also staff training, and of course, the management performance, those metrics, there must be some kind of governance among the board or among the management, what they think should be. So this, we will discuss how to achieve it. So one of the teaching tips that you need to do for yourselves will be before and after comparative statements so that students can understand what was it before, what is it after. That is a very powerful way for them to get a good picture of what was it before and what is after, because the words in the standards are all like they're very complicating, right? So you have to see actual accounts to see that. Then you should plan this curriculum before 2026 because 27 already applied. So whoever coming out to work should be looking at it. Otherwise, say, oh, I heard about it. I don't really know much about it. All right, so that's what you need to do. All right, so I'll go back to my slide now. All right. So let's take a little bit of the background to MFRS 18, a little bit of the background. So the name of the standard is presentation and disclosure. So it's presentation and disclosure in the financial statements. So a quick overview. So this standard includes, as what we said just now, a comprehensive requirement on the presentation and the disclosure. So now it's going to replace the MFRS 101, which will be known as the extent standard at the end of the day. All right? And so that to enhance what? The quality of the financial presentation, the consistency and the relevance. Now, not that the accounts are not being presented in a proper manner, but still we are tweaking. The standard setter is tweaking the standard after lots of response from the various stakeholders all over the world. So International Accounting Standards Board has taken that step to have that agenda put in their discussions about 2 years ago, 3 years ago. They went through quite a lot and then finally they came up with the standard. So that's the standard we see. So this will replace 101 and many existing principles of the old 101 will be retained with limited changes, but new things are added. So MFRS 18 will not impact recognition or measurement of item, but it will change what you report as operating profit. All right, that's where the biggest point is, because this is the final total where investors are looking. So at the end of the day, what are you earning? All right, what are you earning? The money I put into the company, investing, what will I get in return? Okay. So financial reporting has been very much in the forefront of changes. So it will start on the 1st of January and also applies to comparative information, which means you got to redo the comparatives, and that's the transitional changes that needs to be done. So the presentation might require system and process changes for those who are doing online systems. So the process change will have to be done. And also, as what we always tell the companies, get ready, get your systems ready for this. So trading starts also in big corporate companies. So the key features: simplification of presentation. Despite the standard being a little complicated, the aim is to simplify the presentation. Now that's an oxymoron actually. All right, streamline guidance to ensure financial statements are not cluttered with immaterial information. Now, if you remember olden days accounts, people used to put as much details in the accounts as possible. I do remember when I started, long ago in this profession, some of the directors say, hey, why you all put like that, our group like that? No, put all the details. I want to see the details. So, the whole thing is balance sheet. They go, don't know what inside, other creditors, this creditor, they are all P&L, go all kinds of things. So for them, they say, I know exactly what it is. But then the investor, he's not interested in all that rubbish. So there was a mismatch. So what are we doing financial reporting for? So this is for the stakeholders now. If you want to do management, you can have your own rules inside your company. Show as much details as you want. All right. Even if you buy kacang puteh, also better put there purchase of kacang puteh. Then they can identify that. So improve transparency, enhance focus on clarity of disclosure, so that users can interpret the financial statement, that being the key word. And also align with other standards. So this is to align with other new and revised standards that are continuously coming out and have been coming out, all right? Because first and foremost, financial reporting has moved, as I mentioned the last time, from a purely historical context into something more relevant for the current. That's why a lot of standards were changed. Now, things like investor, when he puts in money into the company, or he wants to look at a company for its ability, to earn income. Is he going to rely wholly on the history? Oh, last time you made a lot of money, so I assume this time you make lah. So when you put in the money, 1 year later, hey, what happened? And this is what happened in the last financial crisis, right? That's exactly what happened. So that's when the standard setter was told, how come accountants who are doing accounts, they only look at the history? Don't they look forward? Now, if you talk to an accountant last time and you say, look forward, they say, you think what? I got a crystal ball in front of me, I can see the future. I only base on history. What I see, I can record. I cannot record what I cannot see. That is the old thinking. The new thinking is to align with the investor's requirement. After all, what are the financial statements for? You want a history or record? I'll go to the museum and see that. All right. So that's why he had things like fair value changes. Fair value is a current value to be shown on the balance sheet on any of the assets. So current value incorporates many, many things. Apart from the fixed assets, it also looks at things like receivable, it looks at inventory. Have you provided the right amount of impairment? Right? Sometimes inventory is overstated. The goods cannot be sold. In real life, when you go to the store there, hey, what all this? No, that one we are keeping. Somebody one day come and buy. I could tell him the price. Now, one day come and buy, that one day will never come. But on the balance sheet, it shows your asset is good. So you need to do the impairment to bring it down to some reality. When you sell, we take that up. Right? When you don't sell, we don't. So similar to receivable. So they brought in the standard of the expected credit loss. All right, as you remember. So this expected MFRS 9 is about expected in the future. You sell a company goods, sell them sales of goods or services. You expect to collect or not. It's the future. Don't talk about, last time history, a provision for bad debts. Based on my historical, that was then. But now, what happens? You sell to a company, economy is difficult, or that company is facing difficulty now, and they can't collect the money. You are looking at the now, right? Not the future. So this kind of expected credit loss is another thing that looks at it. Going concern has featured very prominently in financial reporting because companies want to know, investors want to know, if I put my money, will this company last? All right, at least for the next 3 or 4 years, or will it collapse 6 months down the line? So you see, that's why in financial reporting today, the Securities Commission and the Audit Oversight Board is very, very strict with auditors on this. And you'll see that a lot of auditors, those days, public listed company auditors, never report on going concern the way they do. Nowadays, they don't care whether you are a public listed company, whatever it is. Otherwise, they are at stake, their license. So they straight away say not going concern. Some even disclaim opinion on going concern. Why? Because this is a very important thing. If you say disclaim now, investor will say, even the auditor can't give an opinion on the going concern, why should I invest my money? All right, last time people say, the auditor don't bother, so the financial reporting also doesn't bother, so we put, money inside and then it close, or something happens. So these are things that are changes. There are a lot more, all right, but I'm not going to go into that. I'll give you an idea. All right, so that's why we need to align with all the other changes that have come in. Also, materiality emphasis on material concept to reduce disclosure overload, all right, while retaining essential information. I think one of the things on a set of annual report that you will see is the voluminous amount of notes on the account. Well, it's necessary anyway, all right? So to avoid some more volume added to it, so they try to make it a little bit more, reduce a little bit, but not very much, all right? And most important, focus on the user, the investor's need. All right, enhanced requirement to present information in a way that becomes more meaningful to the user. So we are now looking at presenting financial statement meaningful to the user, not meaningful to what we think it should be. So we shift our focus on what will the user be looking at. So it is a balance between what is the numbers in the financial statements, the actuality of the numbers, and what are they looking at. What is actual? Is that sufficient? Or do we need to look at it greater? For instance, like the machinery, I tell you, yes, we got plant and machinery, 50 million, so nothing wrong with it. It's there in the factory. But is that what an investor is looking? So we have to go shift a little bit more now, all right, into the investor's view. So this adoption is part of the evolution going on, all right, in the whole financial reporting, which is actually keeping financial reporting very much alive, all right. I remember in the old days, in the 1990s and beyond, I mean, let's say 70s, 80s, 90s, financial reporting never moved. It was just the old, whatever method it was. There was some, vague attempt at it under the Statement of Standard Accounting Practice, SSAP, which was not really, mandatory in Malaysia at that time. It was voluntary. Some took, some did not take, until formally the standards came. So this is why there are also the evolution of the financial reporting to address the limitations of the present IAS 1 or MFRS 101, which I said was a 2005, discussion. 2005 when they launched it. All right, when IASB launched the accounting standards, it was in the year 2005 and not now. So how many years have passed? So it's to bring in alignment the rest. So the first thing is addressing disclosure overload. 101 has excessive disclosure, obscuring the most important. Disclose. So at that time was no disclosure. So then they said, all right, we better disclose so that people can make a decision. So better disclose became a lot of disclosure. Then it became information clutter. So investors looking at it or any user reading it was so much a thing I can't read. So this is where to fine tune it, all right, to bring it down. So it's more targeted approach to prioritize the relevance of a disclosure over the volume of a disclosure. So is the disclosure relevant? So relevance over the volume. Some people write a lot of notes. Improve alignment with what the user expects. So this is what everybody should know. The students should know that accounting is now going more towards the user friendliness of it, not that set of standards sitting there and telling that this is what it is. You better understand what it is. Now it's the standard saying, let's find out what you want, and we will report it so that you can understand. All right. So it is about you modern users, investors, regulators, and also analysts. Incorporates feedback from extensive consultation. The IASB did quite a lot, all right? And that's how they came back to become more user-centric. So consistency with the revised standard. So because the law standard revised, so it's changed with the issuance of standards like MFRS 15, revenue from contracts with customers, and also things like MFRS 16, which is leases, which once upon a time, leases were always an off-balance sheet item, never had an on-balance sheet. All right, so liabilities were omitted. At that time, it was the only way to do, or you don't own the asset, how could you put an asset on the balance sheet? That was the argument of the days gone by. But today, the argument is different. You have a right to use that asset. So a new terminology was created on the right to use. So that's why now all this must be brought in. So that right of use has got a depreciation, although the asset does not belong to you. So then what about this issue about the lessor owns the asset, you also own the asset, the right to use. If you lease it out, the other person owns the asset. Three people are owning the same asset. Three balance sheet got three same asset going. All right? So you see all these are the standards as it is now. And then MFRS 9 is the financial instruments, which has gone quite extensive now compared to before. And it aligns the present requirements with the newer standards, professional judgment. So the management is required to use more professional judgment when they do the accounts, right? So the old standard provided a lot of rigid rules limiting flexibility. Now, one of the hallmarks of the IASB standard, when you compare with the US GAAP, all right, generally accepted accounting principles in US, is that the US GAAP set by the Financial Accounting Standards Board in US is more rule-based. Everything is rule-based. But the IASB standards are more principle-based. But having said that, not everything could have been achieved using principles. So therefore, some of the standards, when they were set way before 2005, they were still rule-based. As you know very well, these standards became very important after the collapse of all the major fraud cases in the world. The notable one, I think you all will know, is Enron. Enron had its heyday from 1991 or 1990 right up to the year 2001. All right? When the financial director, Sharon Watkins, came out and exposed that the company was, fiddling with the account, the figures were all false, blah, blah, blah. Yet it was the biggest industry. Bankers were knocking on the doors of Enron to give them money because their results were so good, but all was a big fraud. And then, of course, you had the other cases like Parmalat and a few other cases, all during that heyday. So that's when the International Accounting Standards Committee, IASC, was reformed into an International Accounting Standards Board, all right, in the year 2001. And then they began setting the standards. And that's how the first standards came out in the year 2005. So we are looking at an environment then and coming to, that a period after all the fraud. So now things have become more sophisticated. So as a result of which standards are becoming more and more, sophisticated itself. So you need to have professional judgment for information tailored to the entity's circumstances. Also, international comparability. So the accounts that we produce are used by international investors. You want money to flow into the country, you must have transparency in financial reporting and consistency in financial reporting. So if somebody reports something, their interpretation is different from our interpretation, because in Malaysia, some of us will tend to tweak towards, the other end of the thing. So then you need to make it more standardized. So this is one of the steps of standardizing it. All right, so there was also the investors' concern. One of the driving forces is investors were the one who were complaining the most about financial statement. They say there's a lack of clarity. Despite the fact that so much is being disclosed, the investors are saying there's a lack of clarity. How does that work? All right? So investors found disclosures too dense, really too dense. And the key information is all buried in the details. We got to read a lot. Nowadays, people don't like to read. All right? Nowadays, we send WhatsApp messages all short form. Not like long story, put an email. Even the email becoming obsolete now. Everything is using WhatsApp. When I'm dealing with a client, you ask them to send an agreement over, it comes on the WhatsApp. Huh? Last time they sent on email. Olden days, you have to send by post, the snail mail. Now it's WhatsApp. You want now? I give you now. So you see, things are different. I mean, there is a need. There is what is happening today in the world. You have to accept. You cannot say, oh, I don't accept all this. Give me the snail mail. I can read. I can open my eyes and read. No, I can't see otherwise. Now that is the old. Today you just want to glance, understand it. You got the gist of it. What do you want to do with all that? All that paper. What do you do? Today we are talking about ESG. All right, environment. Why are we damaging the environment by cutting the trees and then making the paper? After making the paper, we read already. Throw the paper away. All right, then we got to do something and then recycle the paper or do something. So the problem is every time you're cutting the tree doesn't goes up straight away. All right, so the carbon cannot be absorbed. You know, trees are the ones absorbing carbon and giving out oxygen. So as you know very well, in the world, the temperature is rising. Now all this is related to all this. Temperature is rising. So we had the Paris Agreement, where Malaysia is a signatory, where we agreed that the temperature, world temperature, should not go up more than 1.5 or maximum 2 degrees Celsius from now until 2050. All right, so what we all try to achieve is what they call a net zero. You will be giving out carbon, but you need to, offset that carbon by planting more trees and stuff like that. That's why the government is planting a lot more trees. So this is called the net zero. So putting a lot of paper today is not producing net zero. So we have moved on to all these electronic storage. Even paper is now reduced to a minimum. Electronic storage, of course, has got another story there. A lot of electricity is being used, and that's a thing for another day to just talk about. All right. So MFRS addresses this by clearly distinguishing between what is essential information and what is non-essential. So previously, all information must be disclosed, yes. But now let's categorize what is essential and what is not essential. Highlight the essential information. All right, so that's one of the hallmark of the standard. And then inconsistent presentation across entities. I said, we look at the upcoming slide. Variability in applying the old 101 led to inconsistent presentation formats, and that made it very challenging when you compare one entity to another entity. So comparability was somewhat reduced. And this standard established very standard presentation, and this is not going to make it perfect, but it is going to improve comparability. That's what it does, all right, improve. Nothing is perfect in this world. So we can improve every time we work towards improvement. So 101 failed to highlight critical management judgment. Although there is a standard that talks about management judgment, if I don't want to put it, you won't see it. All right, so it failed to highlight those. And also limited insight into the judgment. When you make a judgment, the directors or the management don't have to tell you why they did that. All right, you don't know the background. So now you must provide clear explanation and on the significant decision affecting financial statement. So now you know why, the reader will know why certain things are put in the financial statement or P&L as it were. Focus is on material information. So investors raise concern about irrelevant information cluttering the financial statement. So again, what is irrelevant? Okay, and we have been doing 101 for so long. Nobody thought about it. So suddenly we have to, take a step backward and look, hey, what are we reporting? Are we reporting what the user wants? Are we so entrenched in the standard that we follow the standard to the letter and forgot the rest of the world don't understand what we are writing? So every time we are writing with detail, I'm complying with the standard. Yeah, I'm complying. But forgot who is the one you are writing for. You are writing to impress that you can write. You are writing to impress that I'm following the standard. Or are we writing for the investor? This whole account is for the investor. The accountant is facilitating the investor, not facilitating that he knows the standard very carefully, very well, and the more detail he puts, that he can say that he is very qualified, he can put as much details as is possible. You fellas don't know how to write properly. You see, I wrote, but who is reading? Nobody is, right? So, the demand for greater transparency, enhanced transparency in the financial performance, position, and risk was the key demand of what the investors wanted. So this one, the new standard mandates disclosure that is actually better meeting these transparency requirements and the demands of the investors. All right? So now, this is the inconsistent presentation, as I said. Variability in applying 101. This is one of the differences. 101 provided general guidelines for the presentation of financial statement, and it gave a certain amount of flexibility to the companies to decide how to show it. All right, how the guidelines are applied. So this is the rules of principle. I give you the guideline, you apply flexibility. But then investors say that companies apply the flexibility to the advantage of the companies to show what they want to show you, not what you should see. I can tell you what you want to know, but the real facts I don't want to tell you. I know what you want to know, I tell you. So I can also show what you want to know and hide the other information somewhere. So this is what caused this, all right? So while flexibility is beneficial for tailoring the report to specific industries, it often results in the following, and this is what the problem was. All right? Non-standardized subtotal. That's one of the things. Non-standardized subtotal. So in the P&L, when you go subtotal, they are not standard. So permits, the old standard permits you to define and present subtotal like operating profit or EBITDA, earnings before interest, tax, depreciation, and amortization, the EBITDA, all right? So you can have, without stating the composition. So my EBITDA can be changed, in order to make it look better, right? So this led to subtotal calculated differently across different entities. So when you compare EBITDA between different companies, it looks different, right? It looks different, or it may look good, but in reality, it's not really what it should be. So that is one area. So varied formats on the statement of financial position. Some of the entities opted for current, non-current classification. Others use liquidity-based. Now, when you put current, non-current, it's very easy to understand and analyze the balance sheet vis-a-vis the profit and loss account. But when you use liquidity-based, you can actually obscure the ratios. It can easily obscure because you're focusing something else on the profit and loss account, but the profit and loss account, something else on the balance sheet or the statement of financial position to obscure how to compare the performance with the position on the balance sheet. All right, so later we will look at some of this. So varied formats. So while both formats were permitted, the variability created challenges in comparing industries with the same. If one used liquidity method of the balance sheet and another one used the current, non-current method. So judgment in classification of item allowed discretion, the old standard, in classifying item as operating, investing, or financial in the cash flow. You make your decision, all right, where you want to put it. So certain items could be put in investing, certain items could be put in operating. Like if you have interest expense, certain interest expense can be operating, certain interest expense can be investing. All right? So you make that decision. If you want your cash flow to look how, you put it that way. So here again, there were inconsistencies in this. So variability, for example, consider two manufacturing companies. Let's say one is Altis Berhad and the other imaginary company Berjaya, operating in the same industry. So everything is the same. Altis statement of profit and loss says revenue, cost of sales, gross profit. Then they also show other operating income. They also show selling and distribution expenses. They show administrative expenses and the operating profit. Now, Berjaya says like this: I show the revenue, I show the cost of sale, I show other income, I show distribution, and I show the administrative expenses, and I show profit from the operations. Now, what's the difference between the two? All right? Looks all the same, right? Now, what is inside distribution? What is inside administrative? So, key observation. The heading operating profit used by LTIS is labeled profit from operations by Berjaya. So you can see that operating profit, profit from operation. Looks the same, isn't it? But this is where people get confused. Even though they represent the same financial metric, why can't you have everybody saying operating profit? So this is what the standard wants to go. Profit from operation means what? Operating profit. Yeah, it looks the same, but it confuses you, right? So LTIS explicitly presents a gross profit subtotal, which you can see here. There's a gross profit, but these people don't have a gross profit. Okay? So while Berjaya does not, even though both entities can calculate from the disclosure, you need an investor to carry a calculator with him. Let me see. Oh yeah, this one is this. Now I got to calculate. Why can't I see it? I can't see it. I don't want to show you. So analysts comparing LTIS and Berjaya will need to standardize their presentation, requiring additional effort, leading to misinterpretation. You have to have a calculator and try to understand, right? So another company, our balance sheet versus liquidity base. This is current, non-current versus liquidity. Let's look at this company, Cahaya Berhad, using current, non-current assets. Current assets like inventory, receivable, non-current assets, PPE, intangible asset, etc., etc. Then they got current liabilities, payable, short-term debts, and non-current liabilities, long-term debt. All right? Then we have another company, Diamond Berhad. They want to use the liquidity method. So they show assets, cash and cash equivalent, trade receivable, inventory, plant and equipment, liabilities, short-term debt, trade payables, long-term debt. So they show like this. So what is the observation between the two? Chaya groups item into current, non-current categories, while Diamond presents order of liquidity. Now, investors analyzing companies in the same sector, let's assume that Chaya and Diamond are in the same business. All right? So they will find it harder to compare liquidity or solvency metrics if they adopt different format. So just looking at this, how do you compare the liquidity here? Here is easier to see. Current asset, your current assets and your current liabilities, all right? But here is a bit more difficult to see. You're talking about short term, you're talking about assets. So do I have enough money to pay my creditors? You can't see it because it's not current, right? So how MFRS 18 is addressing all these problems? It's standardizing the subtotals. So it mandates using certain subtotal like operating profit with a clear definition so that there is consistency across all the entity. So now we use operating profit, not profit from operation or net profit or what's that? Then what is it, you see? So defined line items. Entities are required to present specific line item reducing flexibility in labeling and grouping, which enhances comparability. So it is reducing a bit of the original flexibility, but it is enhancing comparability. More prescriptive presentation. So from a rule, from a principle base, we are moving to a little bit to prescriptive, and that will be something like a bit of a rule. So basically, of course, extremes are not good. Putting totally your own judgment is not good. Following full rules is also not good. So always somewhere in between, the balance in between. So that's how the standards are slowly being adjusted to come to that, all right? Reduces the discretion allowed in classifying items like cash flow so that there's greater uniformity, and also encourages the consistency in an industry. So while retaining some flexibility for industry-specific need, the new standard still says use consistency on the same sector. So this inconsistency under the MFRS 101 created law hurdles for user of the financial statement. So all this improvement is to standardize presentation, making it easier for the end user, the stakeholder. So all this we are doing is we have realized, or the accounting industry has realized, that while MFRS 101 was good at that time, things have changed in the world. Users want more definitive, information to compare. Comparability becomes important. So that's why the standard is a very live standard. We are changing to keep up with the standards. The new changes, what are they? New subtotals in the statement of profit or loss. So they introduces subtotals to enhance consistency and comparability. Standardized subtotal is operating profit or operating loss. So it's operating. So everybody knows this is operations. Clearly defined as the entity's profit or loss from operations before you put in finance income. All right, interest income, finance expenses, and share of profit from associate and joint venture. So you see, finance income is from probably your deposits or loans that you give out to people. You got interest income. Finance expenditure is part of your expenditure, but it is expenditure that you incur if you borrow money. So if the company, one is borrowing, one is not borrowing, the metrics are different. All right, compare, hey, this one different from that. Why this fellow not doing so well? So if we take out the finance and compare both, then you can find both are doing exactly the same. This one has got a loan, so he's got to cover the finance. What if he was going to get, convert the loan or get some shares coming in, new shares? Then he will reduce that ability or repay the loan, all right, or reduce that interest element, bringing the profit to a more manageable level. So these decisions can be made by the user, all right? So that's why take out the thing that's cluttering it, finance. So take it out, all right? Also, profit or loss from associate and joint ventures, some go and put inside profit from operations. So operating profit before investing, financing, and income tax. So now the profit is before investment income, before financing, and before this. So a new subtotal that isolates operational performance, excluding item relating to investing and finance. So now it's really your operation. Is this business viable in its original operation, or is the original operation already going to die? But they happen to have a lot of reserves, so they are investing and getting income from investment, or they're getting a fixed deposit interest and topping it up, and then they say operating profit. So I'm okay. But actually the business is dying. All right, so every business has got a life cycle. It goes up, then it goes down. So what keeps the life cycle going in many companies in the world that you can see? Innovation, R&D. If you do not do R&D, you do not spend money on R&D, you can't innovate your product. Competitors will come in with new products and you will die. You can see so many things in the world going on that way, right? So right now, the current thing is what you see. Last time was like phones. Now we are looking at cars. What is taking the world by storm now? Electric cars. All right? And who is doing the most is China, who seems to be, every other car that comes from China is an electric car. And they are they're this thing. Yet it was the European Union that mandated 2035 as being the year they will have no more ICE or internal combustion engine cars, the normal petrol-driven car. They wanted to get rid of petrol-driven cars because it gives out a lot of carbon dioxide, monoxide fumes. So to reduce that, to reduce global temperature, cut down the use of all this fossil fuel. So that's why they started this. But in the end, the Europeans could not keep up with it. They don't have enough electric cars. Mercedes came out electric, and a lot of the Mercedes had a lot of problems. So now they're withdrawn, now they're coming up again. BMWs have got it, and a few others got it. But look at China, non-stop. All kinds of names I never heard before. Zeekr, what the, oh. And I see them on the Malaysian road. What car is this? Zeekr. All right. Anyway, we in Malaysia, we only know one, Proton. All right, EMAS. And even EMAS, I never see the car in the KL showroom in KL. I don't know where it is. Every time I pass by a product showroom, oh, we don't have. You can see the catalog. You want to order, you can order. All right? So where did I see the car? Once I came to Kuching. Not here, Kuching. So it happened to be in that mall where we were training. There's a mall attached. So I said, hey, what's this car? Iman. Oh. So when I was sitting in it, so the sales girl told me, KL, the price is a little bit cheaper. In Malaysia, is a bit more. Have you seen in KL? I said, no, I never seen this car in KL. First time I'm seeing, I live in KL, but I come and see the car in Kuching, Until now, I cannot see, but on the road, I can see a few. So, yet you can see all this. So, anyway, why? If you do not keep up with the times, just like olden days, when the British and the European countries could not keep up with their production methodology, Japanese cars, which were then considered tin can, all right, this is like Milo tin can, Datsun, tin can. But then they became the mainstay of everybody. Everybody drives a Japanese car. So now it seems like China is taking over. Japanese are trying to take a Chinese car and put the Japanese name on it. And that's what Toyota is doing. All right, and I think Nissan is also doing that. So you see, things are changing. If you do not keep up, that's what companies will do. So companies will go down. So I'm saying that operations will go down. But if you have a lot of reserves, you can hide that final figure by having your investment income, your interest income, your whatever it is. And so you really never say whether the operations are dying. All right, so this is what it is. So this is the illustrative example, very simple one. So this is the 101 format. This is the MFRS 18 format, all right? So here we have revenue, other income, cost of sales, all right, gross profit, operating expenses, profit before finance and costs, all right, cost and tax. This is the operating profit. This is the operating loss. Operating expenses, operating loss. But here we never have this unless you put a category profit before finance, cost and tax, which nobody does. Finance income and finance costs, then only you put that in. Then you call that profit before tax. Now you call it profit before investing, financing and income tax. Then you put the income tax and then you have the profit. Now, you see the perception is different. The numbers will not change. Nothing will change your business by changing a standard. The standard is the one that changed. Your business didn't change, isn't it? So only the results will look a bit different. All right? Later, we will also look at the actual one. So the benefit will be the subtotals, which are these subtotals here, right? This operating loss. These are the new one. Gross profit, operating profit or loss, and profit before investing. So you know exactly what this is, okay? So this will give a clearer insight into the core operational performance to enable better comparison and standardization, reduce ambiguity in what constitutes operating profit. Operating profit is nothing more than, it includes other income from your operations, revenue, and then the gross profit minus your operating expenses. Operating expenses will not include finance and finance costs. All right? Neither will it include any investing income. All this out. So, management define a performance measure. So this is the MPM we are talking about. Management define performance measure. So they give a little bit of leeway now. You decide what is your performance measure. So what is an MPM? It is a management a defined performance measure. They are financial measures which are defined by that entity, all right, that MFRS standard do not explicitly require. These measures are used internally to assess performance and are communicated externally to shareholders. So if you use that, you must explain. So why include MPM disclosure? Because previously never asked you to do. Stakeholders like investors rely on MPM to understand the entity's unique performance metric. Again, different industries have unique performance metrics. So trying to group all together may lead to a wrong conclusion. So we want to see what is management defining their metrics, and then we try to go along with them and try to understand, right? So why the lack of standardized disclosure about MPM under MFRS 101 made it difficult to validate the accuracy and consistency of management perform. So it's like management judgments. So compare MPMs across entities. So the key disclosure under this MFRS 18, clear definition of each MPM. Later we will see an example of what this clear definition means, all right? And also a reconciliation of the MPM to the most directly comparable subtotal required by the MFRS standard. So explanation why management considers the MPM useful to stakeholders. This is a new area in the standard, MPM. Consistency in MPM across reporting period. Example of an MPM disclosure, adjusted operating profit. So you have adjusted operating profit. What the hell is that? So the definition will be operating profit excluding restructuring costs and one-time litigation expenses. Last time you don't say this. Now you specify. So you can actually identify the item. Otherwise, say operating, I already put restructuring costs inside. I am supposed to show what? It's part of my operating cost what? But you never defined it, you see. One-time litigation expenses. So a reconciliation must be done. Operating profit as per financial statement, say 10 million. All right? Restructuring cost is 2 million. Litigation expenses 1.5. So the adjusted operating profit is 13.5 million. Actual operating profit is 10 million, financial statement. Actually, after adjustment, the real operating profit of the company is 13.5. It's been brought down by restructuring and litigation. But when you read this, you'll see, oh, you're operating only 10 million. The other company has 13 million. You're not so good. But when you say something like this, then you see, oh, these are one-off expenditure. All right, so it will not it's not be recurring. The real profit of the company is 13, which is similar to another company in terms of this thing. So this is the MPM's job, all right, now. So transparency, how does it help the stakeholders? Transparency. MPMs are not used to mislead or obscure financial data, all right? So it does not, they are not used. Facilities comparison of the entity's performance over time by taking out the unusual item shows separately. So your real operation, profit is still the same. Relevance provides insight into management perspective of the key performance driver. So what are the key performance driver in an organization? So they should not be obscured by unusual expenditure. All right? The third one, enhanced guidance on grouping, aggregation and disaggregation that we talked about just now. So this MFRS emphasizes a more balanced approach in when you group together or you break it up, right? Aggregation is grouping items that share a very similar characteristic. And disaggregation, breaking down the big item into components that provide specific information. So that is the definition of aggregation, group together and take it out. So what's the problem? Why is the guidance necessary? Under the old standard, entities aggregated too much information, resulting in over-summarized financial statement. What I don't want you to know, I group together. What you don't need to know, I show it. All right? So then what will happen is that loss of critical insight into specified financial items. So alternatively, too much of details, excessive disaggregation should result in cluttered financial statement, overwhelming users. So if I show you too much, then you'll be wondering as an investor, wow, this one has so many of this, how? That one is so clear like that. This one, am I supposed to add or subtract? Or why this one so complicated? So it confused the user of the financial. So instead of giving information by disaggregation is confusing. So where then do you draw that line? So there's a lot of this kind of judgment that comes in. So that's the beauty of the standard setter, to get all this information and then collate that, have so many discussions and come up with a final standard. All right. So under the MFRS 18, use number 1, the materiality principle, the one we talked about just now. That same materiality principle. Ensure that aggregated information and material does not obscure significant detail. So whatever you aggregate must be material in the definition of what the user of the financial statement would make a decision. All right. If he makes a decision that's going to be different, then that is material. If he does not care about that information, he considers it not material, then that's not material. As I say, that is a definition without a definition. All right, it's a judgment definition. So breakdown of the significant line items, for instance, breaking down other expenses into specific categories if they are material. For example, legal fees, marketing costs to stakeholders. All right. Now, the legal fees. If your legal fees is big because of a particular litigation issue, then you break it down. If your legal fees are not big, don't go and put one item, legal fees, 300 ringgit. You say, must show legal fee, I show what? So, but that's not relevant. You're cluttering. So again, this is the judgment here, all right? So if they are material, marketing costs. Well, I've already incurred. No, this one we had a special promotion for the new product we launched. So our marketing cost was very high for this year because we launched a new product, but I put that marketing cost. All right? So next year, another marketing cost. So should I disaggregate or not? So again, these are the issues, you see. Also, uniformity across statements. Aggregation and disaggregation principles should be applied consistently across all primary. So let's look at one example here. So this is about one illustrative example, just hypothetical. Before, under MFRS 101, other expenses, 15 million. Okay, other expenses. But now, after MFRS 18, other expenses, break it down. Why I need to disaggregate? Because it is such a big figure. So I want to disaggregate. 5 million is legal fees. Marketing cost is 6 million. Consulting fee is 4 million. So now it gives a clearer picture, all right, about what is the breakdown rather than looking at other expenses 15 million. So this is the kind of differences, all right? Now, how does this help the stakeholders who are looking? Users will gain insight into specific nature of expense and income. Now I gain an insight. Now people will know. Now, usually you might follow up this about marketing expenses, a note about new product was launched. So people know, oh, so this is a one-off expense. It's not expected to recur. So after extra spending on this, let's look at the results moving forward. Maybe they will improve the results after spending so much on marketing on a new product. So you see, your mind will be focused on the future. That's why I say accounting is all about the future. Investors are looking at the future. Accountants cannot be inconsistent and talk about the past. That is the old accountant. You know, some old accountants will tell you a story. You don't tell me all this rubbish. I've eaten more salt than you have eaten. I don't know what they eat salt. Salt is no good for health. All right? You'll probably get high blood pressure. But that was the language they used. So they are talking about when they were working in the, in the paddy fields or working in the plantation, hard work. Yes, they were sweating a lot, so they had to take stock. We are sitting in air-conditioned atmosphere. Go from here to there, so must drive on. Cannot walk, hot sun, you know. Cannot, the umbrella don't have drive. You see, the life is changed. So, but we don't think of it like that. So that's why all these things about eating more salt and all, I always like to tell that story. All right? Moving on. So, second, apart from relevance, enhanced comparability facilitates better analysis and decision making for investors and analysts. So this is the primary purpose of financial statement. Some people, I ask, when we talk to people, your financial statement, okay, yeah. We did already, very fast we did already. After all, we need to file with SSM. You mean you're doing your accounts to file? Yeah, because of a dateline one, So must file the SSM. So aren't you looking at the stakeholders? No lah, file the SSM lah, after kena penalty, You see, the focus is so way out sometimes. This is exactly the case. Sometimes I'm talking to practitioners, all right? They're telling me, file with SSM. So filing with SSM is not the primary objective. That is only a statutory requirement to file so that everybody can access and see. But your focus is out of focus. I mean, a lot of accountants. So that's why we need to teach the young students what is the purpose of financial statement really. Sometimes they work in firms and they say, deadline coming. So the total objective of presenting financial statement is lost. All right? And then facilitate better analysis, reduces clutter, focuses truly on matters, avoiding unnecessary disaggregation, unnecessary immaterial items. So try to focus on important items. All right? And then these key changes ensure that the financial statement provides clearer, more consistent, and more meaningful. In other words, something that is already good, we are polishing it to make it look better. Not that there was a deficiency wholly in MFRS 101. MFRS 101 had a good purpose from the time we did not have it until now. But then it also needs to be fine-tuned so that it can be improved. Everything needs to be improved, right? Cannot be stagnant. How are we on timing? Oh, sorry. Okay. I think we will have a tea break. You want to announce a tea break? No need? Yeah.
When I walked in, I saw a group of bubbly people. Yeah, because the atmosphere when I walked in and you guys were responding to Mr. Selvarajah, it's not easy, not at all places, yeah. And then I can see some activities. You guys were having discussion. It's quite nice, and we are happy to sponsor this program actually. Now, I think I've not seen most of you because we only did the regional level at Sarawak. Any one of you went to Sarawak last year? Was it last year? Went to Sarawak last year? Yeah, a few only, right? So we were debating actually. I suggested to Has, the person in charge, liaison person at MIA, why not we bring the session to Sabah? And I'm sure there are many lecturers, seronok kan, who would like to attend. The challenge is when it's done outside Sabah, and it's not only talking about monetary, you got to travel and other things that you need to do. At least here, you can focus, yeah? And we can bring many people here. All right? So maybe next time kita consider lagi lah, okay? Maybe lah lepasnya. Now, I am attached to Business Development Manager in Employer Relationships team. Prior to this, I was in bank for 17 years. I was in corporate. So corporate in many departments, training, marketing, product development, you name it, like 17 years in 9 departments. I didn't feel it. Unless you stay in one department, then you are like, your aging process is faster, I think. That because, we're different departments, and I also at certain time led, I headed like bank campaigns annually. Yeah, so kalau nampak lah kadang-kadang with M-Bank last time. Campaign, Islamic Bank campaign, gold or what not in 2012, 13, 14. I like that program. Anyway, and then I decided enough is enough with banking. I want to do something else. So that was a decision that changed my life. So I went to KLMUC. You remember last time sekarang tak ada, Cosmo Point. I was in Careers and Partners. I did job placement for students, sessions. And after that, I was invited by my friend to join ACCA. I thought I will last only like 3 years. This year is my 10th anniversary. That long, Rasa macam, sekejap kot, 2 tahun, 1 tahun, 3 tahun, macam environment is different. Corporate and education, a program like this is totally different. The pace is different. Like in M-Bank, for example, in one day you can have 4 or 5 meetings. You send email, in half an hour I can get the answer, the response. So I got to manage myself, okay. Then after that, Alhamdulillah, the thing is, when I resigned, I told my boss I wanted to do something different, to give back probably, to nurture the growth of young people. So I was in training last time. So macam very interesting training. You train people, yeah, and then soft skills, product knowledge, financial planning. Yeah, macam some people say that kenapa undur ke belakang? Not really. When you feel like, okay, maybe I can give back, do something for the students. Now I'm handling all public sector related activities. Training, macam contoh, if you have heard of JP Pro Matriculation Program, that is like our elite program. It was started in 2018 and it's like my baby now. So engagement, Jabatan Accountant Negara, Jabatan Audit, Recruitment, and talk, I arrange. So anything in the public sector is under me and my boss. There are only two of us, very lean, yeah. Sorry, yeah. It was challenging taking a flight yesterday. You know, tahulah nose block kan. The pressure was like, oh, okay. Anyway, okay. I don't really have any slide to share with you, but I just want to update you on some changes that you might have known about FIA qualification. You know, FIA qualification, yeah, now has been accepted by MQA. With for student who has this FIA qualification can now venture into, if they want to do a degree, if they want to do other program, they can. Before this, the laluan is only FIA to ACCA. Now, kalau student nak buat FIA, then after that they decide, oh my God, I think after FIA I want to do something else. They can. Ya, FIA is 1 year. Dia macam lebih kurang macam matriculation macam lah asasi. So now they can go to other program. It opens the door for more opportunities. Because why? Kadang-kadang some student at this point, okay, I want to do this. But after 1 year, decided, okay, I want to do something else. Kalau we don't, it's opportunity. Or else, mati-mati pun they have to do ACCA. Okay. Not to say that ACCA not good. At certain times, student realize, okay, I want to do something different. After completing their degree ke apa, then they decided to come back buat ACCA, just do the professional paper. So we open doors to so many opportunities. Kalau ada student, anak-anak nak buat, anybody wants to do FIA, ambil je. Because the advantage, upon completion, you can straight buat ACCA, or even you can do other program. Why not? Yeah, it's not just for ACCA, okay? Okay tak? Ada orang kata, oh my God, you are killing lah. You're killing the group of, I mean, why don't you just make it mandatory? FIA must go to ACCA. We wish you can do that, but we do not want to stop people from exploring. So jadinya, bila FIA dah habis, nak buat benda lain, okay, please. Then after that, bila dah kerja, sometimes discovered, I want to be chartered accountant, they can come back and dapat exemptions. Okay, that's the way we think because we want to meet the global needs. Okay, now, dulu we had CAT, right? You remember? Then what happened to CAT now? Do you know anything about CAT now? What happened? Boleh tak ambil CAT? Can. Do you know that? Dengan College Professional MARA, we have DCAT program. Okay, kalau, this is for your info. DCAT is actually a diploma in accounting student. They do 2 specialized CAT papers dan dia dapat CAT qualification tambahan. So dia dah ada diploma, they got this professional qualification. When they go for interview, they have something extra. Because we do realize that when job street, for example, advertisement for a job, the requirement of employers, one of it, professional qualification, or even doing partial professional qualification, being accepted as well. Okay, now for your info as well, ACCA exploring into TVET. TVET kan dah become so, even parents, anak dapat 7 A's, 8 A's, they wanted to push for the children to do TVET. Of course, TVET, they got to give, opportunity to those who are actually not, in terms of academic, not that, high. But again, if those students with straight A's, 6, 7 A's, they want to do TVET, it shows the potential of it. Yeah. And for your info, ACCA completed our roadshow to college vocational to offer dual diploma for college vocational student. Maknanya student ni when they graduate, DIA student DIA students, there are also DIA student at college vocational. Yeah, they can get dual diploma with ACCA. We completed that. We got 217 students from college vocational, embarking their journey, to get dual diploma. Sekarang when you go for interview, because when I was in the bank, I also interviewed people for my team. So one of it that we like to see candidate who like to explore. They don't only focus on academic, because TVET students, when they graduate, they have a lot of certification kemahiran. When I asked them, they have at least 3. That itself, employers said that for TVET students, we don't have an issue. We just employ them. They already know how to do their work. So tak adalah macam zaman-zaman I dengan you kot. Dapat manual tebal. Kan, ingat kan? Boleh kan sing kan? You guys are still young. When I was in the bank, operational and method, that material so thick, okay? So nowadays, kalau your children wants to explore on perhaps certificate as well. And we also have ACCA learning, guys. Certification, micro-credential. Okay, nanti I'll share with you the link to that ACCA learning. There are free of charge courses that you can take, that even student can also take. And also there are with payment as well. And also kalau your university would like to buy that certificate, for you or for students also can. There are package offered. Nanti I share the link to ACCA learning platform. Sustainability, for example. Atau data analytic. We have certificate like that. For data analytic, I said for that courses, it's good. So explore that, okay? So I don't want to take, how long I have taken? 10 minutes. So thank you so much. I hope you enjoy the sessions. InsyaAllah ada rezeki, we'll see you, or maybe we bring back this session to Sabah in the future, okay? All the best.
All right, let's continue from where we stopped off. Right, so I was talking about the objective of the financial statement when we stopped off for a tea break. So let's look at this. First thing, the objective, the big picture. Why do we have financial statement? After talking what we talked this morning. So it is to understand the entity's financial position. What are the assets? What are the liabilities? And what are equity? This is what the student needs to know, right? The financial performance, what is its income, what are its expenses, and what results in the change in the equity, the retained earnings. And what are the cash flow during the reported period? The performance does not equate to cash flow. There are companies where salespeople are very enthusiastic about selling because they get sales commission. So they sell and they sell and they sell on credit, but they don't collect sometimes. They say, oh, I'm the sales. I don't collect because that's the accounts department's job. If I don't sell you people in the account department won't have a job. So they have this, So they think they're very high. Well, they sell, true. So, but the thing is that when they sell, the profit and loss account shows a better profit because you're selling more and more. But it doesn't translate into the fact that a lot of your sales are not collected. All right, because nobody's chasing. Collections is an art. Collections is something very psychological. When you sell something or you give a service to a customer, you must collect the money. That's the most important. If you do not collect, people put you in the back burner. I got money, the fella didn't chase me, I used for others first. So when he chased me, okay, next month I pay. Sure, pay you one. Next month I forgot. You forgot. So by the time it goes into, some months, it is virtually impossible to collect because the person got so many other commitments by then. So collection is an art. So the thing is, companies like that who sell and sell and sell and don't have a proper collection procedure are bound to get into cash flow problem. Right? So that's why cash flow is very important. You can sell all that you want. Your profit can be huge, but your cash flow is negative. It means you are a dead duck waiting to close down. That's all it is. So that's why we have to relate financial performance, the ability to earn money, with the ability to collect the money. That's the real life. Right? Earning money is no use. So just go on comparing performance of P&L, assets, yeah, very good performance, but the cash flow is all negative. So you see, this is where we must emphasize cash is very important in a company. That is the lifeblood of running. So therefore, this is about, getting these three items. So the information intended to be useful in a wide range of users, investors, lender, bankers, other creditors, in making this about if you are going to provide a resource to the entity, like lenders, they are giving money, creditors, they are giving goods, hoping that you will pay them in the credit period, right? And also any others like investing or lending. People who invest in your company, in shares, or maybe you want money, so you issue a bond. So people invest in a bond because bond has a higher interest rate. Obviously, it also carries a higher risk. But then it's about risk and reward. If you put in the bank, you'll get 2%, 3%. Sampai tua. All right, so people want to have a balance in their investment. So I'll put some in the bank, some I'll put in a little bit higher risk. All right, so I'll put it in a bond. So when you want to put in a bond, the first thing you're putting your money in a high risk place. Wouldn't you think that they want to see your financials? Are you sustainable? Can you sustain? If that money is put in, what's going to happen to money? Your previous business didn't manage to run. Now they put new money, it will run. Am I putting good money after a lost case? So these are things people also want to know. You see, so this is investing or lending. Assessing the management, stewardship, and accountability. So looking at the financial statement is only not about numbers. It is about how the management is running the company. It's a sum total of getting the results right, getting the cash in, and progressing with the products or whatever they are selling. They are keeping up with the market. Sometimes you have a wonderful company, but they are not progressing. They die along the way. They die off along the way. All right? As I said before, maybe you have heard this. What happened to the top phone, handphones makers once upon a time? Motorola. The big thing. 1988, 99. So big. You bang the table, everything will fly up except the phone. So big. Hello? All right? They were the king at that time. Then came on things like Nokia, the Swedish company, was the king. Do you hear of them now? What are you using? Anyone using Nokia phone? Motorola phone? We all say, oh, yeah, iPhone. Oh, you're using iPhone. They don't say, hey, what are you using Nokia phone? But at that time, that was the only one. Why? Because they could not keep up with the time. They did not reinvest their money into research and development to carry on. So now we are fighting here among the local brand. I mean, the brands in Asia. All right. So you have this iPhone is fighting with Samsung, Huawei, and all this kind of thing. Huawei has been put down because they cannot use Google, and all this kind of thing. So you see, technology is different. Now they are talking about 10G. That day I was reading 10G. We just gone into 5G. Where is the 6, 7, 8, and 9? We've gone to 10. I don't know where. They disappear. Next one, we're talking about 20G or 30G. Yeah, so anyway, it reminds me of all these computers of the days gone by. When we first started, we had something called 8086 chip. Then was something like 8088. Then they had what they call 286. Wow, 286, very powerful, no? Double, no? 386, wow, this one is very good. 486, then came 586 Pentium. Today, where all the name? Don't know where really. I also can't keep up with what kind of chip numbers they have. They're all funny things. So it has progressed so far. That's the development. That's the development. You see? So you have to keep developing. Then we have this Intel and AMD. So one time Intel was the king. Now AMD seems to be also taking a big chunk. Every time you walk around in the shopping and you look at that, AMD chip. Intel got all the AMD. You say AMD just as good. You try and see, it's very good. So I see. So this is what you call one day you'll find AMD and no more Intel. Don't know where Intel went. What is that? Intel? Never heard of it. All right. I mean, this is what you call, companies understanding the stewardship. If the management runs the company is forward-looking. Running the company is forward-looking. Financial statement is also forward-looking. So today we have to think differently, not like the olden days, eating more salt. All right. So a complete set of financial statement is a statement of financial performance that we all know. But this is for a recap. So it reports the entity's financial performance, includes revenue and income, expenses and losses, profit for the period, and other comprehensive income, as we all know, OCI, like gain or losses on revaluation or actuarial adjustments, right? So a complete set of for example, as a format. Revenue, 500,000, cost of sales, 300,000, gross profit, 200,000. Simple. You will learn bookkeeping already, you learn this. But we're looking here, talking university. Anyway, operating expenses, 50,000. Operating profit, 150. All right, this minus this. Finance cost, 10. Profit before tax, 140. Income tax, 30. The profit for the period is 110. Right? Other comprehensive income, that's a revaluation gain on maybe your assets. All right, so 105,000. Total comprehensive income will be actually 110 plus the 5,000. So that's the P&L. That's the P&L. Now the balance sheet. It presents the entity's financial position at the end of the reporting period and includes assets, current and non-current. All right. For those accounting students who are not very strong, these are very good, basic structures for them to understand. Liabilities, current and non-current. Equity, share capital. Reserves, retained earning. So what are reserves? What are retained earnings? Well, these are things that we can explain, right? And assets, current assets, cash and cash equivalents. These are current assets. Trade receivable, inventory. So total current asset, 300,000. Non-current assets, property, plant, equipment, intangible, and total non-current assets, 1.2. So 1.2 plus 300. This company has altogether 1.5 million in total assets, both current and also non-current. So people can look at the structure of the current. You got 1 million in plant and machinery, intangible. So the question is, under the rules of intangible, only if they can earn income, they will remain on the balance sheet. Then again, it's a matter of interpretation. Research and development is an intangible. So research must be written off. All right? But development can be retained if certain conditions are satisfied. So those are intangible. Other intangible, trademark. You purchase a trademark or you have purchased a patent right. The patent right gives you 20 years to manufacture under the patent name. Now, it does not mean that if you paid, let's say, 10 million for the patent right for a right use for 20 years, so you're going to depreciate over 20 years, and that does not mean that your patent as an intangible asset on the balance sheet is the actual figure. Don't forget, there are other new technologies that are coming up. Your patent may still have another 15 years to run, but nobody wants to buy the product under your patent because they're newer technology. So what is the value of that patent? The intangible. Who does that valuation? Who knows about it? Company may know. Will they report it? Will they want to report something not favorable to them? So this is the things that, you need to understand. Looking at a set of accounts, sometimes you need to go deeper behind the numbers to understand a lot of circumstances. That's why when we are looking at accounting, we must have the background knowledge of the business, the industry in which they operate, what is the market conditions today. So all this will affect. Now, with the Trump effect, so-called Trump effect, all right, everything is going upside down. So will it be the same? Or is this a flash in the pan? Trump came in, everything go up. Slowly, everything will go back normal. We don't know. So there are uncertain times ahead. So how would you put numbers on the balance sheet and the profit and loss account? Will the Trump effect have anything? Will there be tariff, his own funny way of calculating tariff based on balance of trade? All right. Of all these years, we learned about, tariffs. There's always a protectionism and stuff like this. And today he comes out with a new story. But the trouble is, he doesn't explain. He just changes as he like. Today he got tariff, tomorrow I suspend it. All right. So anyway, what I'm saying is all this affects the numbers and the figures. So we must be aware, not because Trump is a great man, but because this silly thing affects all of us. All right. All right, and investments. So investment is up, the next day is down. So if you're having a balance sheet position on that day, when Trump announces some stupid thing, all investment went down, value in the balance sheet gone down. So there'll be a huge impairment of fair value change in the balance sheet. But after the year end, it slowly goes up. So does the balance sheet show a true and fair view? Does the statement of financial position show a true and fair view? Because at the material time, it is down. But when you look at financial statement, is the balance sheet as bad as that or not? So they still haven't found a magical way of identifying what happens if subsequent things change. In the old days, when this kind of investment, let's say 31st December, let's assume Trump made some stupid announcement and the share market collapsed. So on that date, your value of the investments would have gone down. So you'd have written a fair value changes going to P&L. P&L dropped. So when you compare, all right, last year and this year, what? This year result very bad. So because of Trump. Can you say because of Trump? You can't put the nose on the account, isn't it? So then, but after the year end goes up, maybe 3-4 months later, it's back to its normal. Can you say that after the year end, things came back to normal, so I don't want to change because I did my accounts 3 months after the year end. I want to show the balance now. I don't want to show the balance at 31st December. But the standard don't allow you to do that. They ask you to show 31st December. So what will be the management response? Nothing to stop you from writing in the notes on the account, hoping that people will read. Subsequent to the year end, the value of the shares has increased or whatever it is. You can write all that, you see, but people don't read, say, hey, this balance sheet habis already. This company bunkus. So you see, a lot of these things, when you look at numbers, numbers can be very, you have to go behind the numbers. So that's why we want the people to know, the students to know that you have to go behind all these simple numbers they don't understand, All right, so that is the total assets. And then here you have liabilities. Trade payables, short-term loan. So that's the current liabilities. Then you have the long-term loan and the non-current liabilities, 550,000, all right? And then you have the total equity. So this is the complete set of financial statement as it were. But within that, there's a lot of things they can do. And then the statement of changes in equity. Reports changes in the equity section of the financial position. That's what this statement reports. It reports the changes in the equity. So it includes comprehensive income from the period. All right, so comprehensive income can be either carried forward or it will be recycled to P&L account, the other comprehensive income. Contribution from and distribution to owners. Contribution from his shareholders, putting in money. That's contribution from the shareholder. Distribution to owners is dividends payable. Dividends paid. All right? So, equity at the beginning of the year, total comprehensive income, dividends paid, closing equity. So what does it say? How come this one went up? Because you made a profit. But out of the profit, you already distributed some. So you have a net accretion in your opening equity by 65. Because out of the 115 that you made for the year, 50 already paid out as dividend. Here again comes the question. You made 115 for the year. But if you did not collect it, let's say near the end of the year, you had a massive sale. Sales went up, and it's sale on credit. Business to business is credit. So after the year end, you can't provide for bad debts. You provided for expected credit loss under MFRS 9. Right? A small percentage because some will be lost. But the big chunk is not provided. So you assume that that is the profit you made. So under our Companies Act, it says that as long as you make profits, you can distribute a dividend. So you have this 115. So I want to distribute 50. I have some cash. So I distribute 50. But after the year end, 6 months, 8 months, all this done already, a lot of the debtors cannot pay. Maybe because of some economic downturn or something happened. All right? Or suddenly India and Pakistan started a war. Or maybe, the US started a war with China. Or everybody is, rattling their sabers and we hear noise, ooh, scared. So then the results go down. So, is this correct? So the point is that there must be a point in time we have to take. We cannot say, what happened if this happened? What happened if that not happened? So we take a point in time, but we must be cautious. So whatever numbers that we read today of a 31st December 2024 accounts, it was situation on that date. What is happening today, we must be aware of the situational issues and then look at the numbers. So this is something, financial reporting is about numbers given to you on a date. All right? And as far as possible, try to anticipate the future. So this is the things that you need to know. Now I give you another example. Inventory. Big companies like Harvey Norman, right? And what else? Some big electronic companies. They have a very peculiar pattern. They buy their goods, they will sell. For example, electric kettle, nice electric kettle, 400 and something, 480 over ringgit, very nice. Wow, look at it, very nice. $400 boiled water, $490, no. Okay, so you walk past and go, nice to keep. 3 months later, you walk again, hey, sale, Wow, now only 390 baht. $100 went down. Hey, nice, but still 390. All right? Then you go back another 3 days. Harvey Norman sale, babu. You go there. Hey, 265. Now cheap. All right? The point is this. At 31st December, when they valued their inventory, they were expecting the old story. All right, which is what? Lower of cost and net realizable value, right? So let's say their cost, for example, let's say their cost is 250, simply put. All right, to simply put 250. So they are selling just above cost, no problem. But what happens? New model coming. So now they're having a very special promotion. Promotion. Nice words, What are you promoting? I'm promoting an old stock. For you, it's a promotion. For me, it's to get rid of it. So promotion price, all right, now is 180 ringgit. I got quite a number of stock. I'm selling special for this festive season. Promotion, 180. So when the accounts were done, that stock was in the closing stock at its original cost, say 250. But would you anticipate next year 6 months down the line, new stock coming out. All this stock is going to be sold at 150. Nobody will know. Yet, you need to work out a pattern. What kind of impairment would you need to put? And it is not accurate. What if the model happens to sell out? What if it cannot sell? So you see, the numbers on the balance sheet is about a lot of judgment and awareness of the market. This is what we must be aware. Different products have different peculiarities. All right, so that's why I say it's only a snapshot. But what I'm saying is that to the person who is being taught on accounting, that this is in a state of continuous change. All right, we can follow the principle, but interpretation is different. Is the skill of interpreting the account. Doesn't mean you got skill, means you're accurate. Skill is only at that point in time. Now we are looking at a situation of fluidity in the world. All right, one side got war here, one side there. That time when there was the Israeli war, there was another big story. Now all quiet there. Now coming here, India, Pakistan, the noisy again. Then I don't know what else will come out. All right, Trump against trade tariff will come out. Or he might say, oh, you're occupying too much ships in the South China Sea. I want to put my tanks there or my big ships there. I mean, all kinds of things can cause havoc. Because if you have a person like Trump, who very unpredictable to me, all right, very unpredictable, who acts alone and is not acting in this thing, it can cause a lot of chaos in our financial reporting, in our interpretation of figures and numbers. So this is something that as we go on, we must understand this, all right? So that's why when you see this, it does not mean your comprehensive is there. You may not have actually realized it, no. You have taken at 31st December all steps to ensure that it will be realized. But events subsequent to that, you may not know, all right? Statement of cash flow, it is to provide information on the cash inflow and outflow, operating, investing, and financing as we know. So net profit, adjustment for non-cash items, take out all that non-cash, changes in the working capital, I owe you, you owe me, all that changes, what not collected. So the net cash from operations is 115. Your profit is 110, but your net cash is 115 because all debts may have been collected. So it has come up. Then purchase of equipment, you invest 50 million or 50,000 in equipment. So when you invest, you would expect that the future will be brighter for the company because you have new equipment. You would expect that, right? So you'll also have to look at this. So the net cash used in investing 50 and the financing. So you have paid back your loan. That means you have some money to pay. Net cash used in financing is 10. So you have a general increase in cash. So it tells you a picture. Generally, your cash flow is okay. You are investing in new equipment. Overall, the cash is increasing and not decreasing. All right, so it gives you a good picture. So everyone tells the story. And then the notes to the financial statement will provide information on things for you to understand the financial statement that we talked about. Comply with the disclosure includes significant accounting policy. There's one note just on a long story of the different accounting policy. That significant accounting policy, if not properly framed, all right, people don't read, you can actually adjust your accounting policy to make it look better than what it is. Again, nobody checks that in detail in the SMEs. Public sector company, maybe the auditors will look, but in SMEs, people don't look. So people do not understand. Investors do not understand. All right? Assumption, judgment, and estimates. An estimate, again, is always subject to fraud. I would say fraud, I'll put it in the worst possible way. Why is it fraud? Let's take, if you're a contractor. You know, Malaysia is very good in developing. So we have a lot of contractors doing all kinds of contract work, right? So big contractors, small contractors, don't know, in between contractors. So one of the critical thing in contracting is this, something called in revenue recognition, taking up profits over time. So over time means olden days language, progressive profit basis lah. So what is this progressive profit basis based on? Is based on expenditure incurred to date. How you know incurred? Oh, get the architect or the quantity surveyor to certify how much incurred. Yeah, can. Over total expected cost to complete. So this project is running over 6 years. You are now in the second year. So now, second year, third year, my profit not so good lah. So I'm going to do this. I'm the management. Look, Mr. Quantity Surveyor, I need your help. Can you adjust the cost to complete? All right? And bring that cost to complete either if I want it higher or lower. You tell one story lah. Tell him, because now we revise, because the future price of steel is going up. You know, this because of that, because of this, because of that, or the other way around. Because of the world production is increasing, the future price of steel and building materials is going down. You can tweak either way, isn't it? So now, if I adjust the percentage of completion is a numerator over the denominator. Numerator is the cost of work done certified. Over expected cost to complete is the denominator. So if I increase the denominator, my percentage of completion will reduce. So I take less profit. Why? Because paying too much tax. I don't want to pay so much tax. You know, we are making too much money. No, push. So what will happen? You show less result, right? Now let's say it's the other way around. Investors want to come look at your company. Our profit not enough lah. How to increase? Increase the cost to completion. And then what will happen? Your percentage of completion will go up. Or go down, sorry. The other way around. When you reduce it, the percentage of completion will go up. When you increase your cost, vis-a-vis, let's say you incur 100,000, total cost to complete is 1 million. Let's say, put small figure. So 100 or 1 million, that's your percentage of completion, 10%. Now, suppose I put, instead of the 1 million contract, and we paid 200,000, 100,000, 10 million is 10%. Now, what happens if 100,000 over 1.5 million? What is the percentage? Go down, isn't it? So what if I reduce it, increase it, or cost is going up? Percentage of completion go up or go down? Now, everyone is confused. Simple mathematics. So that's why when you increase it, cost goes down. When you decrease it, the cost of completion, percentage goes up. So now I want to increase my percentage. So I'm going to reduce the costs. All right, so I got my percentage. So my estimated profit for the year, which goes in the P&L account, is a much higher figure than what it will be because I tweaked the estimate. You see, there's so many things you can do then, you know. This contractor's nonsense. Yeah. So, you know, that's why when I'm doing audit, we have to do a lot of work, go and talk to the contractors, the QS, this thing, look for evidence as to why you say increase or decrease. So all these things you cannot see in the front. So if you don't look at it carefully, it's like that. So similarly, just now, when I talk about the inventory valuation, it's much, much lower. You don't understand that it's going to go so low when they sell. So your valuation of stock is higher. Your year-end profit is much higher, which you will never realize because subsequently you sold the cattle for well below the cost and a substantial amount. But that hidden loss never appears. Right? So this is the practice of the side of practice. Theory is different from practice. All right. A major line item, and then also we have comparative figures. notes and comparative figures to allow us to evaluate changes over time. It's all very nice. Changes over time can also be affected by decisions like what I just told you: inventory valuation, trade receivable valuations, things like contract estimation, any estimation for that matter. All right, provision for warranty is an estimation. So let's say you come up with a product. I mean, you've been selling a product, you have a provision for warranty in the account, which means your profit is brought down by the provision. How do you base that provision for warranty? Based on your experience in the past. All right, you're selling the product, the failure rate of the product may be 15%. So every time you're selling, you know that the failure rate is 15%. So your provision for warranty, you put at 15%. You come up with a new product and you still put 15%. And the failure rate, you don't know yet. So they say, no. Our experience is all 15%. What experience? Yeah, that product, but this product, no, it's about the same one. I'll just brush you off. So what actually happened is, I am overstating my profit. Then when the failure rate is much higher, maybe 30%, 40%, then I'll tell you a story. No, that was a fault with the factory. Actually, the product is still good, but there's a fault in the factory. That batch came out, so it was like that. So, but I overstated the profit and cheated everyone. You see, that is where, these are the things that you can do in the accounts, which if you're not aware of it and you don't press the questions, let's say like we are talking to the director, you won't get it. And suddenly you got to say, sure or not. Look at the number of new products that come out. Oh, failure rate is higher. It is natural. It will always be natural. A radically new product that comes out, the failure rate will be higher until 1-2 batches later it will go out. So estimation again will be wrong. All right. So you may just think of all this. So the other one, statement of financial position at the beginning of the preceding year, if this is required. This is when you change an accounting policy, you go retrospective. Remember? Remember not. When there is a change in an accounting policy, you got to change retrospectively. When there's a change in an estimate, you change how? Prospectively. You don't go backwards. So when we are talking about accounting policy changes, you must also go retrospective. And that is also required to show the extra P&L account. What will be the effect on the earlier P&L accounts, right? So let's look at this. The material restatement of prior period is made. So a beginning balance provides a baseline for comparison. Let's look at this example. A retrospective change in accounting for leases under MFRS 16. If you remember, when MFRS 16 came into force, everybody who had an operating lease, which was charged off to the P&L account, never has an asset on the balance sheet, never has a liability on the balance sheet, and the leases are running for a number of years. Suddenly, when the lease kicks in, what do they tell you? Oh, you must now calculate the total amount of outstanding, discount it backwards, and take that amount as your liability. And from them, take the same figure and put as your asset. Then you depreciate your asset. So what about my lease actually started 5 years ago? Can I do it now? No, I got to redo the 5 years lease. As if this standard came into force 5 years ago. So that's why they say retrospective, so that it shows you what is the current state. Suddenly all you write off already, then suddenly you start capitalizing. What will be the effect on your P&L? Wrong, isn't it? So that's why this is when standard starts adjusting for that period. So presentation, a material correction of prior period. So 31st December, current financial. The previous one is comparable. And the 1st January is retrospective adjustment for previous year. So as you know, retrospective, there are 2 types now. One is you adjust in the current year opening balance, retained earnings. Previous year, you leave it as it is. But everything is adjusted in the current year. The other one is previous year, you adjust opening balance. adjust the accounts for the previous year as if it is already the new standard, and then carry on to this year. All right, so all kinds of retrospective methods go. So all this is to show how is the effect of a new standard or a new accounting policy. All right, so these components ensure compliance with MFRS 18 to provide users with consistent. So same thing goes on in 18 as well. Now, the role of the primary statement is the primary financial statement provided to a structured representation of the financial performance, the financial position, the cash flow. So we know these ones: financial position, financial performance, statement of changes, and the statement of cash flow. So assignment of distinct and complementary role to the primary financial statement. What is it? So the statement of financial position, otherwise known as balance sheet. What is balance sheet? A sheet that balance. So that's why they say, whoa. Statement of finance, old language. Your balance sheet don't balance. Okay. Where is your profit and loss account? Yeah, hello. I either make a profit or a loss. I cannot make profit and loss. So now we change it profit or loss. You see this kind of language? All right. So it provides a snapshot of the entity's assets and equity at a point in time. Helps assess the entity's liquidity, solvency, and financial stability. Now, the profit or loss summarizes the financial period over a reporting period, whereas the profit and loss and other comprehensive income show the total financial performance. The statement of changes in equity. All right, now, why are we reading this? Each primary financial statement has a distinct role, yet all work complementarily to provide a holistic view. So you cannot look at the P&L and try to figure out the status of the company. Neither can you look at the balance sheet or forget the cash flow or look only at the cash flow. So the whole idea of financial statement is all these three must be looked at holistically, all right? Each one has a distinct role, but they work complementarily. They work to complement each other. This is what people should know. Say, don't look at it. I look at the profit and loss account. The account not so good. So when people tell me I look at the profit and loss account, then what about the balance sheet? I see the profit, I know already. So I want to tell them, I see you, you don't know financial reporting already. You're talking rubbish, okay? All right. So statement of cash flow shows how the entity generates, how you generate, and how you use the cash during the period. How you generate. If you are collecting your money from the sales, you are generating wealth. And you are using that money to reinvest, you are progressing, generally, changing your machinery for better things. But if you are not collecting and you are getting share capital or loan and then increasing your machinery, then the question is asked, you are taking more facilities from the bank or from the shareholders, but your fundamental business is not generating profit. So you will be always fail. Your fundamental business must turn to a profit before you can make money. Before you can, because when you borrow money, there's interest. When you borrow money, you're going to invest. But your fundamental business running at a loss, your volume of business goes up, the loss will increase. All right, the loss will increase. So if you had, I'm sure some of you may have come across this activity-based costing. The more you sell, the more you lose. You tell somebody, cannot be like, you stupid, what are you talking? More I sell, I can get this thing. But your fundamental formula is wrong. You got to change that formula to a profit. Then the more you sell, you make more profit. Or you make more money. But when your formula is wrong, the more you sell, the more you lose. Yeah, so this actually happened in one case before. One vending company in Malaysia. Of course, now no more already. Died. So this vending manager, I was doing the audit, you see. So he was telling me on the costing, because going through the costing to find out why like this. So I told him, hey, your costing is flawed. You are selling more. You sure lose money. No, I will get the critical mass size. Then I can make the profit. I say, whatever critical mass size of the number of machine, you will still make a loss because your formula is making loss. Every time you sell a bottle of drink or a cup of coffee in the machine, you are making a loss. But I said, no, the loss can be covered. No, he could not understand the basics of activity-based costing. I don't blame him. All right, he's a general manager running this thing. But the point is this, lah. So that's why we have to get the formula right. Does not mean that you're making, that's why I say if your cash flow is not coming in well and you are investing money in new machine, you already have a formula that is going to lose money. But if you change that formula that you're starting to make some profit, then you can talk about critical mass size that's going to increase. Now that's the language of accountants, financial analysts, all right? But the language of a bookkeeper is different. So what we want to impart into all the students' knowledge is the bigger thinking capability, the bigger picture to look at, rather than the narrow debit, credit, and all of that thing. That's a very narrow-minded view. All right? So that's why it says how you generate your income and how you use the cash during the reporting period. Okay? So if you're having good amount of cash coming in, are you keeping it in the bank? Then it's also very stupid. You need to invest in something. That does not mean you must invest only in shares or something. Maybe you put in a fixed deposit, even the small interest. Or you invest in something. Or if you think that the company is making too much money, the best thing is give it back to the shareholders as dividend. Let them do what they want to do. All right? So you still generate income. So sometimes keeping money in the bank, not knowing what to do, is also not a very good way of looking after finance of a company. All right, you keep reserves. Yes, I totally agree. But when your cash goes excessive of the reserve, then you got to invest, do in something else. All right, invest in R&D maybe. All right, supplementary notes. Role of the notes. The notes provide context and detail of the information, and their role is to explain what are the assumptions used and also what are the judgments made. So people who don't read this then don't understand financial statement. There are companies, SMEs, who don't know what is this. They copy and paste. That one got put lah. That company got also we also put lah. So you don't know why you put to fill up your notes. All right, so I've seen that SMEs, all right, small and medium enterprise, they don't have proper accountants. The accounts people don't know anything. Hey, that one got lah. Better put this note lah. Better put this policy. But it has no relevance. So that's why you need to understand when people reading the basis of key decision, which is your assumption, estimate accounting treatment, that must be something written by people who know what they are writing. Okay? And also provide disaggregation, break down aggregated line item into detailed component, types of property, plant, and equipment. So you got property, plant, and equipment. What type of property you have? Oh, we have land. Land is very good, price goes up in value. But what are you using the land for? Nothing, we just invested. So your land is sitting there, not earning any damn thing, waiting for that one future time where the proverbial land is going to jump up in price and everybody is going to make money. But until now, your money is there. You're paying interest on the loan, but you're not getting enough business to even cover the interest. So what logic is that? Oh, because some director will tell you, no, I tell you, investment in land is one of the best things, Land always go up in price. It'll give you a long discourse about what land is all about. No, there's a scarce commodity. It'll go up in price. Yeah. Can you afford it? All right? You're borrowing a loan and you're paying interest and you can't even service the loan because the land price go up. Before the land price go up, you will die. All right? The company will close shop. So you see, these are things that happened in the past before. Because overcapitalization, overusing, using short-term funds for long-term assets is totally out. All right? And then disclose risk information, credit risk, liquidity risk that are not apparently apparent on the primary statement. So we all see financial statement. They do disclose a lot of risks, interest rate risk, a market risk. But do people know what they are reading? Nowadays the notes are very complicated. No. What if because you have to do sensitivity analysis, what if it changes this, changes like that, changes like that? Huh? What is this? So sometimes it becomes overloaded. But then again, it's not meant for people who don't know how to interpret. So the question is, where is the right line drawn? Later I will show you one set of accounts. The variation is so much. If you don't know what you're reading, you'll wonder, what is all this? Don't bother. Is it got to do with the account? I don't know. But it is a lot to do, okay? So highlight non-financial information, include relevant non-financial disclosure like environmental risk, sustainability measures, and management-defined performance metric. So today, environmental risk is a new language. We have the new IFRS S1 and S2. Are you aware? Hello? IFRS S1, S2. They are called sustainability-related standards. All right? Now, this S1 and S2 is already in force from this year. But it is so complicated that Bursa Malaysia has allowed companies to stagger implementation over 3 years, especially the big companies. The smaller ones, you got about 5 years to do it. So that's how complicated S1 and S2 is. It's IFRS S1, S2. So we are now bringing in sustainability-related information into financial reporting. Now, firstly, it might look all very strange. But today we are living in a world where we are killing ourselves because of ESG. Because we are not aware of sustainability. We hear the word sustainable, what does it mean? What does it mean to the man on the street? To an investor, it's becoming more clear. Would I invest in this company that is damaging the environment? Would I invest in a coal mining industry that is damaging the environment? All right? Those days you can hear, would you invest in a tobacco company that is actually producing cigarettes to kill people? You wouldn't, right? So now, E is E. What about the S? Social. Would you invest in a company where they are mistreating the staff? Do you remember the case of the Apple and the outsourced manufacturer in Shenzhen, Foxconn? Been here? Gosh. Let me tell you, because this is all knowledge that you must know relating. Because our accounting today is going on S1 and S2, so it's moving very fast. Now, today is we are at 18. Next time we probably are talking about S1 and S2. You see, we are looking at social. So what Foxconn did was, they are the biggest assembler of iPhone. In fact, they are the only assembler. All right, so they are a Taiwan company based in Shenzhen. So everything that Apple does in the iPhone is they have done the technical work. All the assembly and the thing is done in Foxconn. So all the iPhones here is coming from there in China, all right? Shenzhen is the electronic town. So what was happening in few years ago was that, they got few hundreds and thousands of workers there. They have proper housing for them inside the factory premises. They are worked like hell. And they cannot go back anywhere because it is very expensive for them to leave the place and go back to the town because it's very far. China is so huge. They come from the rural areas and they work. So they have to stay there. Now they've been overworked. What was happening was they began to jump down from the building and die. The pressure was Terrible. So 1, 2, 3 started to die. Then people are wondering, what is this? People are dying. Why am I using an iPhone when people are dying for it? Then Apple woke up. What was that? So they went over and told Foxconn about all this. So Foxconn took a first step. They put netting. So you fall on the net law, you won't die. So that was, of course, not acceptable. So eventually they changed. So the point is, would you buy an Apple phone knowing that people are dying? Would you invest in Apple knowing that people are dying? So this is the social aspect. This is the social. Yeah. This is what is happening now. Your supply chain is being watched. Every company's supply chain is being watched. And this supply chain, if you are a very good company, but your supply chain is killing people or not giving them the right accommodation, like some of the workers are put in a very bad working condition, no house to stay, crammed together, all these. Yeah. Oh, last time already, yeah. Sorry, yeah. So we have to, yeah, I know. So we have to forget the Apple first. Let them die, it's okay. Okay. I was talking about the Apple and the Foxconn. That was the company that was actually employing the staff, and they were not doing very well with their staff because they were underpaying them, overworking them. So when you do that, actually, as the supply chain to Apple, it will affect, now under the new ESG, it will affect Apple. People will say, I don't want to buy Apple, or Apple's name can be badly destroyed because you are actually allowing, right, your supply chain to abuse the workers, which as a result is going to not be conducive to the social aspect of ESG. So that's why today's supply chain is very important as to if you are a supplier and you are not the end producer, you are being audited as well in terms of the supply chain. So what happened here is that eventually Apple got down to them after the second round, and so they changed a lot. So they began to give better facilities for the staff, they get better salaries, and so that's why Apple continued with them. Otherwise, they threatened to pull out the assembly to another company in Taiwan. So this is the story of ESG and how it works nowadays in the new era moving forward. So when we're looking at financial reporting, S1 and S2, IFRS S1 and S2, we'll be talking about these things. Who are your supply chain? Who are you buying from? That sort of thing. And have you inspected whether they are complying with the environment, social, and governance situations? So things are becoming very different moving forward in financial reporting. Exciting? I would say yes, because this, in fact, is a very interactive situation between people who are buying, the manufacturer, the sales, and everyone in the supply chain. So that will automatically get things back in line, especially all the bigger companies when they got to report all this, you see. Then there is also not only reporting. Coming on is another standard, all right? And that is also for sustainability assurance. That's auditing this S1 and S2. So as you can see, everything is changing. So we are very focused on the environment, the social, and the governance. All right, so here is the financial portion of things. The S1 and S2 is about the environment, social, and governance portion of things, which all are becoming part of financial reporting. All right? Okay, I was saying this thing about, the notes provide additional context. When there are any assumptions and judgment, we need to explain why is the key decision made? What is the basis on which that key decision was made? All right, and also estimates accounting treatment, and then provide some breakdown, the disaggregation, line item into the detailed components and the type of plant and equipment. And we are going to do one small exercise, not exercise, an example shortly. Yeah? So disclose the risk information. As I did say, there are a lot of risk information shown. If you know how to read the risk information, it will tell you what happens if there is a problem and suddenly the interest rate risk goes up. What will be the effect on the company's result? Those are the things already enumerated in the notes on the account. So a person reading the notes will be able to say, oh, whenever you hear the government say you're going to increase the base lending rate or increase the interest rate, what will happen to this company? What if they reduce? What's going to happen? So all these are actually here. So they are actually all this they are not apparent in the accounts, but they are in the notes on the account. Then non-financial information, as I was telling you, environmental risk, sustainability measures, or management defined performance metrics. So this MPM is the one that we are also talking about. So identification of the financial statement with the prescribed information to be disclosed. So this MFRS 1.8 mandates that entities identify each financial statement clearly and include the prescribed information prescribed in MFRS 18. The name of the entity, the reporting period, of course, we always do that. The currency used and the level of rounding, whether statements are consolidated, they are already done now, but these are very specifically telling you now. Specific line item, revenue, cost of sale, operating profit, total assets, and liability. And then explicit subtotal, operating profit or loss, total comprehensive income, all right? So how frequent do you need to do this? They must be prepared annually with interim reports if they are required by regulators, for instance, like quarterly report by Bursa Malaysia. Consistency, consistent presentation and classification across all the reporting periods, because sometimes companies tend to change from one year to another without explaining, all right? So it's not consistent. Entities must disclose significant accounting policy assumption estimate to ensure transparency, clear classification, example, current versus non-current, operating versus investing. So nowadays, now the trend is to identify, right? Also, new comparative information for all primary financial statement, numerical information, numbers, previous year's period, we do it. Narrative information, qualitative, like description in changes of any operations or policy has also to be done. And also descriptive information, this is narrative, this description, significant description between this year and the prior period amounts. If there are changes, it's also done. But now it's been prescribed in the standard. So if revenue increased 20% compared to the previous period, the note should describe the factors driving the growth, like new product launch, expansion into new markets. So this kind of thing was never done before. But this gives a lot of additional information to those who want to know why revenue increased. Other than just guessing, I think maybe the market is good. All right, this is not a guessing game. So specifically state why. So this will give clarity that there is a new product launch. So next year, there will not be a new product launch. You expect the sales to be maintained at the new level, right? And then aggregation, we talked a lot about this. Similar items must be grouped into meaningful categories. Meaningful, right? So what is meaningful? Something that has got meaning. Very helpful. Huh? All right, anyway, meaningful categories. So that means you should not mislead it, all right? Meaningful. So there are only a few categories now prescribed. And so when you add together, don't add material information and obscure it. If it's material, show separately. That's the root of this new standard. If it's material, show separately. So disaggregation, material item within a category should be disaggregated. Take it out to provide detailed insight. example, breaking down other expenses into, as what we said, legal fees, travel expenses for any particular use. And this aggregation will tell the user to see that they can see the individual components contributing to the overall cost. So in other words, with a little bit of information, you can see the bigger picture now. Whereas the financial statement today, with the information given, you can't see the bigger picture. So it's a slight shift in what is reported. Because last time you would not know all this. It's all hidden. So you don't know whether there's any legal case the company. Now, there was a legal fees. We will be asking what's the legal fees? Why? What happened? The company is being sued or what? All right. So if you are an investor or you're putting in money, obviously this is focused on your mind to ask the management, what exactly is this legal fee for? Or somebody sued us, we just settle. What do you mean somebody sued you for what? All right. So or product damage or something like that. So all this will be better explained. So faithful representation, this is the same term in the current one. It provides enhanced guidance on aggregation and disaggregation to make sure that there is a faithful presentation in the financial statement. Now, let's look at this example before the aggregation, all right, what we normally used to do. Other expenses, 500,000. After disaggregation for faithful representation, other expenses like what we saw, legal fees, 200,000, marketing, 150, consulting, 150. So instead of leaving at other expenses and hiding everything, now you need to bring it out, disaggregation. So this is called the faithful representation of the facts. The faithful representation is there was 200,000 in legal fees, which of course anyone will ask the question, why so much? Unless it is a normal item in the balance sheet or profit and loss account, sorry. Otherwise, people ask. But if you group it under other expenses, then nobody will ask. Marketing expenses, why? What is the purpose of this marketing? Or maybe you're opening up a new market or something, new product, launch or something like that. And then consulting fees, what are you consulting for? Or what is the issue? So that's the information given. So these elements ensure that MFRS 418 provides clear, consistent, and useful information for decision making. So that basically is it. All right. Now, before we go on to this, I want to look at one of the categories that we talked about as a simple example. Just hang on. I switched the file. All right. Let's look at this. Okay, this imaginary company. Try to imagine. Don't let your imagination go wild though. All right. So what's this? All right, to get rid of that. So ABC Air Systems. If you want to say IA also can. So background, ABC Air Systems is a Malaysian manufacturer of room air conditioners. It generates revenue from product sales, both locally and exported, and maintains a modest portfolio of short-term investment. Is it in the appendix that I gave you? Yeah, okay. The company also leases its factory premises and has 10 million in term loans. So these are the facts. Room air conditioners, revenue from product sales, which is local and exported, and also has some short-term investment. So now you know that this company has also got some investments. All right? Now, the company leases its factory premises and it has 10 million in term loan. So it's not their own factory, they are leasing it. And they got a 10 million term loan. So those are the facts. So let's say this is MF101, the old standard format, all right? So revenue is 100,000, cost of sales 65, so you have a gross profit of 35,000. Then you also have this other income of 1 million, all right? So you got other income of 1 million, and you got selling and administration expenses of 20,000. and finance cost of 3 million, 20 million, sorry. So you have a profit before tax 13 million, tax expense 2.5, net profit. So this is what 101 will show us. So does it help anything to do with any of this, that it has a factory that is leased out and has 10 million in term loans? All right, nothing here. All right, everything is finance cost is stated there. So let's see, when you restructure under MFRS 18, so this will be the categories and the subtotal that you will need to do. All right. First, category item, operating. Under the section operating, then they will show revenue, 100 million. Same category of operating, the cost of sales. Other income. Now this income is relating to their operation. So there could be some scrap sales from the byproduct in the factory, or some, loose tools they sell. So there is scrap sales. That's why this is part of it. So it will come under a reduction of the operating expenses, although shown separately. Yeah? And then you have selling and administration expenses, 20 million. So all this selling express and admin is all part of this operating profit of 16 million. So now we know that operating profit is 16 million purely from the operations. Now, when we look at the previous one here, 101, all right? Can we see anything about what exactly is the operations of the company? You'll say, oh, well, it's like 13,000 is the profit. All right, so is that what it is? That's not quite to understand, right? So now we can see this. Actually, the operating profit is 16 million. Then talk about investing. So they have invested something. So dividend income from short-term funds. They might have put the short-term fund on fixed deposit or on other, more secured funds to make extra money, because the fund is idling there. So they got a dividend income. And this is very specifically investing income. Now think of cash flow statement. We do that in the cash flow statement. So now it goes in the P&L as well. So brings in how many? Fair value gain on investment. So if you had some shares and you sold it, you gain the fair value gain on the investment, shown separately here. And then profit before financing and tax. So operating profit, deduct or add the investing profit or loss. That is called profit before the financing. So you must have money to run the company. Where is the money coming from? It could be all from shareholders, or it could be partly from shareholders, partly from borrowings in the bank, or it could be partly from shareholders, borrowings, and maybe even the issuance of bonds, where you are paying interest on the bonds at the prescribed time. So this will tell you that they have financing. All right, the profit before all this is 16.7. So 16.7 million will tell you how much can you get financing. All right, how much is your financing cost and whether you can support it. So your financing is interest on loan is 3 million. So therefore, obviously 16 million, 3 million is quite fair to get a financing. Otherwise, you use your own money. Also no use, as people say, don't use own money, use OPM, other people's money. So use other people's money. Don't use your own money. But those who are married, I don't think, if you are the husband, that applies to you. Probably your wife will tell you, use your money, my money is my money, your money is my money also. So they say, they follow the principle, use other people's money. But we cannot apply it. All right, anyway. All right, so profit before tax is 13.7 million. Then we talk about, as a result of this 13.5, how much are you paying in terms of taxes? So taxes will be 2.5 million profit for the period. So understanding this profit and loss account will give you a better idea of what are the structure of the expenditure in the P&L, what is the structure of the income. Much better than what we saw in this. This looks okay when nothing is happening. When you don't see the one below, this looks okay. Yeah, this is the way we do accounts. Nothing wrong. What's wrong with that? Anything wrong? Nothing is wrong. but it doesn't show what people want. When an uninitiated looks at this, you won't bother about whether you're looking for what. You'll think that this is correctly shown. What is wrong with this? But to the investor, they are looking for something else. How much money you borrowed and how much interest are you paying? Is the company's operations enough to support your interest? All right? You got some spare funds. How much are you making out of this? You are paying out interest. You are also getting the fixed deposit interest, and you're paying interest. What's the logic for this? Why do you do that? All right? So this was a very simple case in, I think it was Parmalat. I don't know whether you all heard of the Parmalat case. Have you heard of it? Yeah. So you see, among the other frauds in the Parmalat case, they had a lot of money that was supposed to be sitting in a bank in US. They are an Italian company doing milk, or a very old Italian company, the fresh milk. The milk never comes to this part of the world because we get our milk from Australia. So it goes to Europe, it goes to US, it goes to Japan. So anyway, the point is that they had huge amount of fixed deposits sitting in the one of the banks in US, and every time the bank will confirm that this is you know how many $100 million US dollars sitting on fixed deposit. But yet, in the operations, they had something hidden inside, interest on loan. And the interest was a high interest. So people always wondered, why you got so much money sitting in the fixed deposit? Why do you need to take this loan from the bank and pay a high interest for what? So that's why you see, because the accounts were not, it was not noticeable. So in the end, that money in US was never there. It disappeared. Few $100 million disappeared. So then you can explain why they need the operation fund from overdraft. And eventually it was the company closed down and somebody else, I think, took over. I don't know whether it's still called Parmalat or not. All right, so that's the story. So you'll see all these kind of things is financial reporting, and this was also before financial reporting came on, during the heyday of fraud, I would say heyday, when Enron and a few other companies had all these things. So anyway, so this gives you a good analysis of the company's balance sheet, profit and loss account. All right, so I think now this is it's restructured here. So let's look at a couple of notes that I put here. Notice how other income under 101 is now split into operating and investing components, all right? Other income. So the other income is here under 101. So this is 1 million, 1 million. So what is that 1 million? So it is about scrap sales, right? Sorry, wait. Where's the invest? What is that? Is that the other? One income. And the one is now split operating and investing based on the, okay, this 1 million is split into gain on investment, and also it's not wholly that, it's also shown under, where's the other one? Wait. 700, yeah, I saw the 700, where is it? I never appear. Oh, part of the other income is split into operating and investing activities. All right. So this is other income, right? And this is also other income, the 700,000. Yeah. But whereas we thought it's all part of the operations income. I mean, part of the revenue, all right? So that's why this gives you a better. Interest expense is clearly segregated under financing. So this interest expense that we have here, which is not even shown here, or finance cost 3 million, goes separately right towards the bottom under financing. So you see a better picture. It's from what you earn, whether you can pay the financing. In other words, you can see now how many times is your financing cost covered. How many times is your financing cost covered? All right? By the amount of the profit before financing and tax, or you can talk about from the operating profit. So are you over borrowing or are you under borrowing? All right, so what should be an ideal percentage? So it all depends on different industry, different business. All right, how much you should borrow. The gearing is on the balance sheet side. But here is, apart from the gearing, what is the cash that you're generating? Because gearing is just talking about the amount of loans in vis-a-vis the amount of assets. But here you're talking about your earnings can pay a lot. Let's say you go and, you have a lot of house, you got a house, you got properties, everything, but you don't have money in your pocket cash. But you need to pay people. What are you going to do? Sell your properties and pay? You should actually be earning enough to roll, but there's not enough to roll. So here is telling you, are you earning enough to roll? Don't touch your balance sheet. Yes, I know you can sell your assets. Once you sell your assets, that means your production capacity will be also reduced. All right, so it tells a lot more story than the original thing. So this is the thing. All right, so that is part of it. Let's get back. Yeah, we might as well cover this one, huh? Since we already done the slides on this. So the structure of the statement of profit, do you have this? Maybe typeface is slightly different, maybe. Other? God? No God? God, no God? Structure of the statement of profit or loss. All right, never mind. I'll read first while you search. So mandatory categories that we went through, the crux of the standard: operating, investing, financing, income tax, and one more, which didn't exist on our previous example just now. And that is called discontinued operation. All right? So we're going to see how discontinued operation plays a part here. All these categories must be applied consistently to enhance comparability and also clarity. That's the idea. So looking at it some more. Introduction of mandatory subtotal, which you saw just now. So MFRS 18 introduces the following mandatory subtotal: operating profit. You must have the mandatory. So what is operating profit? As you can see here, it is actually the result of the core operating activities. Result of the core operating activities, not other things. Huh? Then you also have profit before financing and income tax, total of operating plus the investing, except financing, we saw just now. Profit before tax, after financing is included. Very structured now. These help standardize the financial performance presentation. And then classification now. Let's look at the classification, all right? Item, sales revenue. The most likely category of sales revenue will be operating. The most likely category of raw material costs will be operating, right? All this is part of operating, isn't it? Dividend income is a passive income. You invest and the dividend comes in. Where would you expect it to be? Investing. Interest income on deposits. You're not operating with it, right? So it's deposits, spare cash invested, and that will be investing. Loans that you take, obviously it must be for some purpose. So it's a financing activity. All right, so it comes under financing. And then you got interest, income tax. Everybody must pay tax. Even you're dead and go to the buried underground or so, the taxman will find you and pull you out. My money, please. All right, it'll go through your estate of your whatever it is. So income tax has to be paid. So income tax is a category by itself. Then, if you have a discontinued segment of a business, if you do not show that it is a discontinued segment, people might not know that this segment will not appear next year. And so, then we say, how come this profit this year went down? Huh? What happened between last year and this year? Don't know what happened. This company is not doing well. But never realized there was a segment that's discontinued. So because there is a discontinued segment that's operating, you will know that next year I know that this would have gone down as well. All right? Then we go further. All right, so we use another ABCIA. This is different from just now. The reason why it's different is actually enhancing. All right, so this is explanation. So that was the old format that we know. So gross profit, actually this should have been pushed there, but I don't know why it came into here. And then here. So with category and subtotals, we saw the 10 million, cost of sales, other income, scrap sale. So selling and admin, operating profit, dividend income, all this come under investing. And then there is also a profit before financing, interest on loan, and profit before tax, and profit for the fee period. I thought I'd put one on this thing. Maybe it's on another example. Hang on. I want to show you the discontinued. All right, we go through bright view later. We must go through the slide, then it is on the slide. Okay, so these are all quite clear now. So we will go on to the following on what we just said, the slide information here. So main categories, the default category is profit or loss, representing actually income and expenses from the entity's main business activity. So this is what you are going to teach them about main business activity. All right, not from business activity, but the main. And includes revenue from contracts, cost of sales or services, cost of service, operating expenses like salary, rent, marketing. And what will this category provide? It provides insight into the core operational profitability of the entity, the core operational profitability. Example, a manufacturing company's revenue from product sale and related expenses belong to operating category, as these are the core business activity because that's the operations, okay? Then investing, income and expenses relating to investment, but exclude those arising from the main business operation. Example, gain or losses on disposal of non-core assets, core assets and non-core assets, all right? Like investment property, equity investments. So they are non-core. Why do you have investment property? For the purpose of earning rental income or capital appreciation or both. Is that the core activity of a manufacturing company? No. They may have had property they rented out. So that's why this will be, exclude those. Dividend income or interest income from non-core financial asset. All this will have to be excluded. Now, this category helps to distinguish returns from investment activities from operational result. All right? Example, if leasing is your core activity, then leasing income is your core activity income, right? So that is what it is. Example, a manufacturing company earning interest on a fixed deposit or selling a parcel of land unrelated to the core operation would then be putting this in the investing category. Interest from fixed deposit, not your core activity. Now, what happens if you are a leasing company? You are earning interest on finance lease. All the interest, is it other income? No, it is your core activity. But for fixed deposit, it's not your core activity. So that's investing. So now we learn to push the things accordingly, all right? And then financing category comprises income and expenses from the entity's financing arrangement. So example, finance costs like interest on loan, lease liability, interest on lease liability under MFRS 16. So when you are looking at MFRS 16 lease liability, right? What do? You calculate the effective interest rate and apply the interest and charge out the interest every year to the P&L account, right? So this interest is actually a financing arrangement. And now all this is created financing. But think of it carefully. Think of it carefully. When you lease, on the surface, is there financing? All right, I lease a space, this space of rental for 3 years. So under the MFRS, this becomes a right of use. And then I have the corresponding liability. And then I calculate using the interest rate on the interest. But in substance, I just pay you a flat rental every month. Where all this funny interest come in? I paid you rent. You never show rent in the accounts. Where's the rent? So when it was shown as rental, people say, where is the liability? You lease this for 5 years, you never show your potential liability. Then the standard setters say, yeah. So we show the potential liability. Now this old man comes along, the one who eats a lot of salt. He says, how come you rent the premises? Your account's wrong. Where no rental one? I don't know what you do here. Where's the rental? I want to see rental. What do you explain to him? No. You know, boss, we convert the rental into an asset. Then we have a liability. Then where your interest come out? Then we have this interest. But where you pay your interest, show me where. Show me where's your check, the interest pay, where got manada. No, this one just figure in the account. Your account's all wrong one about figure in the account. My time, every cent we count one, it's in the account one. What the accounts are you doing? This is what you call the old and the new. Old fellow won't understand this. The new people know exactly what it is. So that interest is actually a notional charge that is charged as actually a cost because of the prolonged lease rental of the space. There's no such thing as free lunch, isn't it? So the lease rental has got an element of interest inside. So that's the simple way of looking at it. So remember, if somebody asks you this type of question, that's how it will be. Like smart fellow asks you, but sir, where is the rental? What rental? You have a rental agreement, isn't it? What does it say there? Every month pay rent. Where is it? Oh no, we converted. So that means you're fiddling with the accounts. No. The fiddling is the correct method. If you take directly, it's not correct. All right, anyway. So example, finance costs, finance income relating to financing agreement arrangement, like interest income from loan to related party. You give a loan to a related party and you charge them interest. Is that your core business? Are you a money lender? Are you what they call a chettiar? No. So therefore, you are actually lending your related company, charging them interest. So this is not your core activity. All right, so this will come under financing, finance income. You are earning an income by using your money to earn that income, giving to a related party. So it's called a finance income. So interest expense on a bank loan used to fund the business is reported in the financing category as, where's my, no, I don't need to. All right. So income tax. includes the tax effect of all categories of income and expenses, irrespective whether they arise from operating, investing, financing activity. Presented separately to show the tax implication of the, so sometimes you have, income tax. Yes, sir. Yes, sir. Yeah, sure. It is also treated like interest, calculated like interest, but shown differently. So the profit from Islamic banking is treated as finance cost or finance income. Correct? Correct. All right? Right, good question. So tax effect. So sometimes you have, tax effect of certain transaction. Like if you're talking about investment income, there is no expenses allowed against investment income, so you must calculate tax separately. And then you have other income, then you need to calculate expenses. Rental income, you are not allowed all the expenses, only assessment, quit rent. So different tax, right? So we say rental tax effect. This one tax effect, no. So it tells you this shows the tax effect from all category of income and expenses. Group it together. It becomes too weird to break up investment, tax on investment income, tax on rental income, tax on operational income. It becomes too weird. So therefore they say, put it all together. So it's presented as one-liner to show the tax implication of the entity's activities. All your activities is a tax. Discontinued operation category. So separately presents income and expenses from a discontinued operation. Allows users to isolate the financial performance to operations that have been or will be disposed of. Don't lump it inside. Show it separately. What have you disposed of? So I think I have an example coming. So includes gain or losses from the sale of a discontinued operation, results of the discontinued segment operation during the reporting period. So let's look at this. If the company decides to sell one of the business segment, it has many segments. So let's say you have a retail operation like a supermarket. Nowadays, supermarkets are all humongous size, right? Huge. And they make huge amounts of money. So they have many operations. Sometimes they say, this operation not doing so well. And somebody locally wants to take over. Okay, I'll dispose it to you. X amount of ringgit, I dispose. I've not ceased operations as a supermarket. I dispose a segment. So that's where you talk about this, all right? Results from the discontinued segment must be shown separately. So if the company decides to sell one of the business segment, all related income and expenses will be reported in discontinued operations category in that segment. So that particular outlet that you sold, how much was the income for the year, how much was the expenditure, and then how much did you sell it for? What is the net amount? So that will be shown separately, all right? Detailed explanation of the main and non-business category here. So main business category, operating includes items directly related to the core generating activities, which we saw just now. The core revenue generating activities is what we need to put. And then that will be revenue from the sale of goods or sale of services directly tied to the company's primary operation. So where do you get that primary operation? Every company will have a primary operation. All right, there could be others that are ancillary to the primary operation. Like for instance, let's say I am a dealer in car. So I buy cars and sell it, but I also service the cars. So now I have an ancillary operation, which is the service of the cars that I sell. So service is nothing to do with the selling the cars, but it is directly to do with the selling the car. Nothing to do, but directly related. That's what you mean, all right? Somebody must not understand this. So it's directly tied to the primary operation. Service is tied to the primary operation of buying and selling cars. All right, so cost of sales. Expenses directly attributable to generating revenue. So you are selling things in it. What are the expenses directly attributed to that selling? All right. Now, such as raw material, labor costs, overheads. So if you are manufacturing, you are selling the manufactured goods, either a completed manufactured good or a raw material to be used for another operation. So you had raw material to make some new material. So therefore, this is all cost of sales, all right? So it is expenses attributable to generating revenue, raw material, labor costs, and overhead. So raw material, labor costs, overhead in terms of a manufacturing activity. In terms of trading, there is no manufacturing cost, right? You are buying and selling. So cost of goods that you purchase, cost of goods sold. But in a manufacturing, you will be selling the final product. But to do that, you'll be buying all kinds of raw materials, right? So now, that raw materials add together, not enough. There will be the factory costs that must be a portion. That must be added. Then there will be the factory overheads that must be allocated. So all this add together is what is called the cost of sales. All right, includes all factory overheads, factory direct costs, factory overheads. Now, operating expenses will be general expenses, administrative expenses incurred to support the operation. Like you need wages, you need to pay people their salary and wages. You need to have a rent if you don't have your own factory. You also need to have utilities. All right, the utility company is not giving you free. Okay, unless you go and fix solar panels lah. Solar panel also cost you, don't know how many bomb. Usually cost you a bomb, but don't know how many bomb. All right, so for a factory to use solar panel, I don't think to run your machinery also enough. Maybe to light up your office can. All right, so this kind of solar panels are also something to do with ESG. All right, so I only bring it in because when S1 and S2 come, we'll be talking more about this. Because solar panels reduce the incidence of generation of electricity using coal or diesel. Now, in Malaysia, I don't know how many dams you have here that produce power. Do you know? Don't even know what a dam is? No? I don't know. Don't know or no? No dam. Small one. Okay. But basically in Malaysia, our mountains are not that high, except your the Gunung Kinabalu lah. But you cannot collect water from there, can you? Huh? So anyway, you need huge mountain ranges to collect large amounts of water, because the higher it is, when the water comes down, it can turn the turbines. You need the pressure to turn the turbine. So we have very little, so we have small amount of electricity. So basically our electricity comes from power generation using coal or using diesel. All right? So both of them make the environment beautiful. Charcoal burning, tons of it. All right? And then diesel burning, nice smell. Enough for you to die immediately. Carbon monoxide. You know how people die? They sit in the car with the engine running, carbon monoxide coming, put a pipe from the exhaust into the windscreen, close it up, sit there, few minutes, you are done with. Next, please. All right. So this is where we are talking about, carbon, being emitted. So the more you use solar energy, you are reducing carbon into the atmosphere. Now, as an example, I recently went to the Silk Road in China for a tour. Now, last time I went was like 7 years ago, all right, all the way up to, from Beijing, you take different modes up to Xinjiang. Now, you're going through a desert, two deserts, all right, called the Gobi Desert and the Taklamakan Desert. They makan you up, no? Serious. Yeah, serious, because the wind is very dangerous desert. Anyway, large stretches of desert. Last time, yes, they got a beautiful highway on the desert. This time got green on the desert. Where's the desert? They have managed to bring water from the distant mountains. and start planting, although not all are all over. So the desert got green color one, no. But that's not all. As I was driving, as we were in the bus going, one area there was so much of solar panels, like don't know 20 or 30 kilometers, and they're stretching about don't know how many solar system deep inside, So I can see how much of power generation China has got from the solar. All right. Now on top of it, they have also this. In the Netherlands, they have the windmill. Now it's called what? There are no more windmills. We don't have windmills nowadays. We have this. What is it? Turbine. Turbine. Yeah, turbine is the thing behind. But what is the main thing called? Jeez. You're living what? Charcoal days. How are you cooking? Using charcoal still. All right. Anyway, these big windmills, so-called windmills, also miles on end. You can see how many rows of windmill. So they have gone into alternative energy. Then don't forget, we all heard about the Three Gorges Dam. I don't know if you heard or not. Never heard of it. Never heard of it? Three Gorges Dam in China. Few years ago, they were damming this huge area, and they were filling up houses that were sitting there. There was water. It's a very huge dam in China. Now, that one produces huge amount because it's very big. All right? And they say that even the dam has shifted, by don't know how many seconds, the rotation of the earth. You read that, you can Google it and see. Because of the mass of water calculated on that hill, on the mountain, huge, it has altered by how many seconds the world goes around the earth because of that. I see here. So it produces so much electricity that nowadays you see China no more like those days are plenty of smoke. Now this is where you're looking at. They don't report this, because the Western media, US, always polluting the environment. So they don't want to say that, oh, this one is different, but you must see with your own eyes, then you will see there's a lot of changes. So what I'm saying is, this done a lot for the environment, because those days was so much of smoke, you can't walk through. So this is the thing that we are looking at moving forward now. Energy being created, through other means. All right. Now we cannot have so much of dam in the country because we don't have high mountain. We also cannot have many of the wind farm. They call that the wind farm. That's the word. Wind farm is the turbine is attached to the wind farm. All right. So we can't have because there's not much wind. It blows and then stop. How are you going to generate electricity? So therefore, the government is looking at the possibility of putting the wind farms into the sea where there's a lot of wind. So may I say it's a sea wind farm. All right. So anyway, they are looking at the possibility of doing it in the sea to reduce the usage of all of this. Now, nowadays accounting, you must bring in ESG. Otherwise, S1, S2, you're going to have a problem. All right. So general and marketing expenses incurred to support the operations, wages, rent, utility, and marketing. And non-main business category like investing and financing, items that are outside the core operations are reported in the non-main category, which is investing and financing. So relates to the acquisition of disposal or return on investment, investing. Example, interest from non-core investment or gain or losses on asset disposal, which are non-core, like investment property. So all this is non-core. Now, financing relates to obtaining and servicing funds. Interest expense on loan, liens, liability, and debt issuance costs. I think by now, from morning till now, you would have got the drift of the new MFRS 18. What exactly they want is, with quite a bit of examples here. So key distinction, revenue from financing arrangement like leasing if you were a leasing company, would be operating in the operating category if leasing is a core of activity. So you are a leasing company. Obviously, your source of income is what? Leasing income, right? In interest income also is leasing. So what would the bank show in their, when they are doing their operations on the bank? Are they going to show interest income as other income? Sounds really weird, isn't it? What's your main income? No, we don't have main income. We have only other income because interest income is got under income. So it looks comical, right? So therefore, this is the logic behind that. Right, so the categories here were in the profit or loss versus the cash flow category. Now we are going to look at the profit and loss and the categories in the cash flow statement. So they want us to look at this. So these categories in the statement of profit and loss are distinct from those in the statement of cash flow, although they could be overlapping. So let's see what happens. When you're talking about the new profit and loss category of operating, the cash flow category is operating also in cash flow. All right, in the cash flow statement is also operating. What are they? Cash flow include all operational cash movement, while profit include accruals. All right, so cash flow is no accrual, but this one includes accrual. Okay, so looks like the same, seems like the same, but not the same. And then investing. So profit and loss investing and the cash flow investing. Profit includes gain, losses, but cash flow only report actual proceeds or outflow. Proceeds coming in or outflow. All right, so that is the profit on the excess proceeds. But for investing is only the gain or the loss. All right, so investing, when you sell the shares, the whole proceeds are coming into the cash flow, right? But in the P&L, is the whole amount shown as your profit? No, you must take out the cost. So in the P&L, only the cost, the selling price minus the cost is the profit. But here, it is the entire proceed. So they look the same, but they mean different. Financing and financing, all right? Financing in the profit and loss and financing the cash flow. So financing profit and loss includes accrual, but cash flow, only what you actually paid. What you are supposed to pay, haven't paid, is not in the cash flow. And then income tax, all right? In the cash flow, it is usually in the operating category. All right? That's why I have profit before tax, and after you add the tax in. But tax payments are shown in the cash flow, in cash outflow, but they accrue over periods in the profit and loss account. So we don't do a profit and loss monthly. If you do, you're supposed to accrue monthly. But nobody does it in practice. All right? But theoretically, that's what you are supposed to do. So whenever you take a profit at the end of the year, it's the profit that accrued on your whole year operation. But here, it is about the income tax is on the actual tax that you paid out. So if you are not yet paid, it's accrued, it's there in the P&L, but not here. Okay? And then discontinued operation. So in the profit and loss account, it's discontinued. In the cash flow, shown in all the applicable categories, cash flow from discontinued are categorized separately for clarity. All right? That is that. But in the cash flow, are you putting under investment? No. It's your operations that has been sold, right? So it goes under the operations by itself. Okay, so whichever category is supposed to be. So if it was an investing cash flow, then it goes under investing. If it's operational cash flow, it goes under operational, under the cash flow statement. So while they are trying to follow, there could be differences and some are overlapping. So, example, presentation in the profit or loss. How categories appear in a statement of profit and loss for a manufacturing entity. Revenue, operating is almost the same figures I use. Operating category, 500,000. Cost of sale is operating 300,000. Gross profit, 200,000. Operating expenses in the operating category is 50,000. So your operating profit is 150. So now we all think operating. Then we talk about investment, interest income from investment is investing category. Gain on sale of property. You sold the property. But what is the property for? Investment. So it is an investing category. So this is the gain on the sale. This is the interest income. So total investing income is 15,000, including sale. Interest expense, the financing category, 10,000. Net financing expense, 10,000. All right. So profit before tax is 155,000. Income tax expense under the tax category, 30,000. Net profit from continuing operation, 125. Now, discontinued operation, you must show separately in the P&L. Remember, in the current standard already, it shows a discontinued operation, show separately. So you'll show profit from discontinued operation separately. And this is going to be also the same in the new one. All right, so net profit is 145,000. This is a profit, so you add. All right. Now, these changes in MFRS 18 are designed to enhance clarity, enhance consistency, and comparability, making it easier for the stakeholders to assess the performance. So now we can understand what the stakeholders are looking. How much is your operating? Is this company making money from the operation? Don't give me all the investing rubbish. I want to buy the company whether it will make the operations from the business. If the business is not making that much, why do I want to buy this company? I'd rather buy the property and get the investment income. Why do I want to buy the company with small profit but big other income for what? No, right? So that's where you can see the disintegration is becoming clear. So presentation of the line items again, explanation of presentation of the line items, the MFRs, along with illustrative for each category. Revenue, interest revenue, using effective interest rate and insurance revenue separately. So interest revenue, if you are a financial institution, all interest income must be calculated on the EIR, or the effective interest rate of the balance outstanding. All right, not on a straight line basis. So EIR basis, that's what you need to use. Insurance revenue will be separate. Insurance company is also in the category of finance, right? Right, so interest revenue using effective interest rate. Entities engaged in financial services like the bank, the leasing corporation, must present interest calculated on the EIR basis. I'm sure you know what is EIR, right? My ears are hard of hearing. I heard very faintly. Okay? All right. Effective interest rate accounts for amortized costs that spread interest income over the life of the financial asset, reflecting the effective yield. I have come across some clown. When I said effective interest rate using amortized cost, I was given a stupid answer. Where got amortization in interest rate? We only amortize the lease. Lease amortization ada. Where got interest amortization? I say, hello, go and read your thing. You're too far behind. You're still eating salt. You better stop eating salt. All right? So amortization is like depreciation. He's thinking like amortization is like depreciation. And then revenue presentation, insurance revenue. Insurance entities must report insurance revenue separately, reflecting consideration earned from providing insurance services. So you provide services that your cooperating service, so your insurance income that you earn from there. So revenue from contracts with customer. This is the insurance, 1 million. Interest revenue, effective interest rate. This is interest. This is the premium collected. This is the interest. This is the insurance revenue, all right, that you get. This is the interest rate. This is the insurance revenue. So all three together, you will get 1.5. One is revenue from your premium. One is the effective interest rate method. The other one is the insurance revenue that you get from insurance as well. This could be selling policy, or this could be commission earned. All right? So operating expenses are to be presented in sufficient detail. What is sufficient? It becomes a judgment here. Sufficient is a judgment. All right? To reflect the operational activities, common line item, cost of sale, raw material, manufacturing costs, they are operating expenses. Selling and distribution, marketing, delivery are operating. Administrative, salary, office rent, we saw. Other operating expenses like impairment. All right? So bad debts, impairment, expected credit loss, they are all part of operating. Why? Because it comes from the core of the operations. When you sell goods, you have trade receivable. And that is from your sale of goods, which is your operation. Now, what happens if you cannot collect the debt because you credited sale and you debited trade receivable? You cannot collect, you make a provision or you impair that trade receivable. Is it part of investment activity? No, it's obviously operations. Can we say, no, I invested in the customer? I gave him credit because I know he's a good customer, he's going to buy. I invested in him, so I want to show you my investment. What kind of logic is this? I mean, if I'm a queer director, I will argue with you. Why not? Why should I give him credit? I'm stupid, I give him credit. I invested, but I know he's a big time customer. So he's going to buy a lot. So I give him credit. I invested. Let's call it twisted logic. Okay. All right, let's look at the example. So operating expenses, cost of sales, 700,000, selling and distribution, administrative, impairment loss on financial asset. So we bring in all that impairment on financial asset. What happens about the machinery? Remember we talked this morning, plant and machinery impairment? We put inside, no, can or not? The word is correct, no, impairment, Why cannot put? Everybody quiet. Financial assets, not tangible assets. All right, so your tangible asset is not an operating expense. Your machinery is not an operating expense. It's a fixed asset. All right, so when you write it down, it doesn't become operating. So this is financial asset. What is the difference between an asset and a financial asset? Let's say one silly student asks you this question. Sir, madam, what is the difference between financial asset and asset? They are all assets. They are all financial. They are all given in ringgit Malaysia. So why not financial? Stupid argument. The difference is an asset is about risk and rewards. If you have an asset, the risk that it does not generate income as much as you expected. The reward is that without the asset, you cannot generate income. So it's about risk and reward. So if the risks and rewards are going to be, less and less, you do impairment. Now, what is a financial asset? It's about rights and obligation. So it's a right to receive or an obligation to pay. So when you sell goods to a customer, what does the customer do? It become a receivable, right? So you have a right to collect the money, the right to receive the money from him. If you bought goods from a creditor, you have an obligation to pay. So this is about rights and obligation. So now I got stock in the company. So what do I do? Financial asset or what? Can I tell the stock, hey, hello, pay up, huh? Don't sit there. You haven't paid. You can't, isn't it? So that becomes like a normal asset. So that is not financial asset. Financial is the right to collect and the obligation to pay. It's about rights and obligation. Asset is about risk and reward. So here we are talking about financial assets. Financial asset about rights. So receivable. So if you have an impairment of a receivable, then you put that in. That becomes under the operation. Why? Because you sold goods, cannot collect, it's your operations. All right? So now I'll ask you a question. Impairment of inventory. Operational, financial, or what? Operational, yeah. Although it is not a financial asset, it is a tangible asset. It is still here. Okay, so that's the way to understand the logic. All right, next one. Share of profit of associates and joint venture. If you are doing the equity method of accounting for the investment in your associate company, entities must separately present their share of profit or loss from the associate and joint venture accounted for using the equity method. So you are getting your income, right? So this line item is reported after the operating profit, but before the profit from the tax. Why? Because it's not actually an operating, your passive income. Investment in an associated company is not your operation. So it's an investment. So when you receive your income from the investment in associate company, it's not your operations, it's your investment, it's your line item. All right? So you show it separately. Here the standard wants you to show separately after operating profit, but before profit from tax. All right? Not before, after financing or anything else. So this is the operating profit from your sales and all that. After that, you put share of profit from associates, equity method. After that, only the finance and all will come in. Okay, so the placement here is slightly different. So share of profit from associate, share of profit or loss from joint venture. All right? And net income from equity method investment, that will be 50 minus 20. So net investment from equity immediately after operating profit. Now, income tax expenses on income, how do we treat that? Income tax is presented as a separate line item showing the tax effect of all income category. All right? That's why I say income from your operations, income from your investing is taxable. Financing, income also taxable, but different method of calculation tax. And discontinued operation profit also taxable. Can you tell the IRB fellow, hey, hello, I closed down the business. I made the profit, but don't tax me. I made profit, no. But it's a closed down already in the business. How you have to pay? Sorry. I don't care whether you close, you pay. All right? So let's look at an example. Income tax expense on income. So profit before tax, 280,000. So income tax expense, current tax is 50,000. Deferred taxation, is deferred tax a liability? It is. Owing to who? Otherwise somebody asks, deferred owing to who? Do I need to pay my deferred tax? You say liability, I must put deferred tax what? So is deferred tax a current asset or current liability? Can be both. So can we have deferred current tax? Deferred tax. Deferred current tax, deferred tax. Deferred tax, yeah, asset or liability. But I'm saying that is the deferred tax, what is my question? You confuse me. Yeah, sorry, that's right, thank you. Is deferred tax current or non-current? So what do I call it? Current deferred. Huh? Yeah, what do I call deferred tax, current deferred tax? Then it's still a deferred tax. So I put current deferred tax, but there's no such terminology. Huh? Well, break up already. Service tax is service tax because service tax is based on provide service you provided. Why you defer? Oh, IRB is. Yeah, that's because the mode of collection is 2 months. So you accrue it in December. January, but you accrue it. It's the incidence of an expense is in December, but payment is January. So that is not deferred. But deferred tax is tax deferred to a future period. So what his point is, what if the tax is deferred for 1 year? Is it a current deferred tax? Have you heard? Because current liabilities, deferred liability. So deferred tax is deferred, right? Deferred means more than 12 months. So if it's going to be payable in the next 12 months, what is it? Current tax. But it's not due yet. It's a deferred tax, not due yet. You only wait until next year you calculate whether the deferred tax reverses. So what do you call that? If you look at the standards, look at the deferred tax standard, they say the deferred tax is always a non-current liability. They say lah. But his point is good lah. Within the next 12 months. The question is, how do you know it reverses in the next 12 months? You can predict the profit. My deferred tax will reverse on. What if you're making a loss? How to reverse? So you got a deferred tax asset. A deferred tax asset is an asset on the balance sheet. So an asset on the balance sheet means economic benefits is going to flow to the entity, right? Provided you make a loss. Provided your loss becomes a profit. If there's no future, possibility of you ever making a profit, do you still call it deferred tax asset? Oh, sometime in the future, don't know when, it will reverse one, one day, but I don't want to write it down. You write it down, my P&L kena, what story is this? So, you see, all this, you need to understand very deeply. In practice, we know all this. So, the thing is, in Malaysia, we only have a 7-year period, 10-year period now. If your losses, you can only carry forward for 10 years. After that, the losses no longer can be carried forward. So if you make profit, then you lose you don't make profit, you lose your deferred tax asset, all right? So all of that will come under a category here, current tax and deferred tax. So it will not go into operating or not. It will come under its own, all right? After profit before tax, the income tax expense is cut into current and deferred taxation, all right? So the total income tax expense includes the current and the deferred tax. That is the impact in the P&L. That is the very reason why you have deferred tax, to equalize your taxation over a period of time. In the old days, they used to call it taxation equalization reserve. Hell of a big name. Taxation equalization. You can equalize your tax, Anyway, all that rubbish is actually simply deferred tax. Okay? All right, moving on. What are we on timing like? Somewhere talk. Forget the timer. All right, results from discontinued operations must be presented separately from continuing operation to highlight the impact. Example, income or loss from discontinued operation. So a discontinued operation is a corporation you close down. So when you close down, you make a profit or loss on the operation. But how do you calculate this profit or loss? Not purely only on that branch profit or loss. You'd have gotten rid of the assets there. There's probably, if it's like a supermarket, you got all the shelves you sell off, all the freezers you sell off, all that will be selling off. So that is your profit on discontinued operation. The operation included assets. So that becomes operation. You don't say, profit only on the goods. What about the sale of all that shelves and that one we put separately? No. In accounting, the whole thing is an operation. So it's a profit on sale or operation, right? So let's look at this. Profit for the period from continuing operations, 200,000. Profit for the period from discontinued operation. So operating results of discontinued, gain on disposal of discontinued operation. So there are two things here, but all under discontinued operation. One is the operating result. The business for that year made a loss or a profit. The assets that we sold also made a profit. So the profit from discontinued operation comprises of the operation and the disposal of whatever assets. So you get 70. All right, now you break it up. This is what you call disaggregation. This morning we talked about disaggregation. So if you just put figure 70,000 profits from discontinued, wow, the bugger stupid for the discontinued operation making money, you go and sell the whole thing. Stupid bugger. Wrong assessment, right? So this is where 101 had this shortcomings, which they are trying to address. All right? So then the total profit and so the net profit of the period will not change, of course. Now, other prescribed items. Certain items require separate presentation due to the nature and the materiality. Now we bring in the materiality. All right? And so, like finance cost, nature and materiality. Nature or. So includes interest on borrowings, lease liability, and other financing related expenses. Now, they require special presentation due to their nature or due to materiality. Show separately. Don't aggregate, disaggregate. So gain losses on disposal of assets, gain on the sale of property, plant, and equipment. You hide it, then you cannot see. So you look like, hey, your profit quite good this year. Right? Impairment losses, impairment of goodwill and financial asset. So goodwill, cannot see, cannot touch. So when you buy a company, you pay extra for the company. You are paying goodwill. So that goodwill in MFRS, you cannot amortize. All right? But in MPERS, you cannot amortize. What do? You test it for impairment every year. Test for impairment. How do you test for impairment? Put the dipstick. Okay? You got to do a projected cash flow and then discount that cash flow. Oh, the figure not nice. I changed the interest rate. This one just nice. Can or not? Okay, don't change the interest. Okay, what figure you want? You don't want me to write out in it. Okay, I changed the assumption. Because the projected cash flow, isn't it? It's based on assumption of sales and expenditure. I changed the assumption. So what? You ask me, I tell you, oh, because of this guy, I take this assumption like that. My sales will go up by 3 or 4%, no, but the next year you see now everything okay, it's going up with 6%, Why? Because I want to change the figure there. So you see, the most important in any cash flow before you do projection is the assumptions. If the assumptions are wrong, you can take that cash flow, put in the dustbin. It's useless. Not even worth the paper it's printed on. Okay, so that's where goodwill is very, to calculate all this, you must know the principle behind it. So here, when we are talking about, impairment of goodwill, the figure is very easy to say, impairment. Yeah, goodwill is no good, impair. How? All right? Some student might ask you how. Of course, you don't have to go into the nitty-gritty, but at least you tell them, projected cash flow. Oh, can I project for 10 years? Now, for heaven's sake, nothing in the world works for 10 years. 10 years ago, if you did a projection, would it be the same as what it is really now? If you did it now, it's to 2025. 2015, you did a projection, 10 years. Will it be exactly what is in 2025? Trump and all came and went. You never got that. So normally you do a minimum is 3 years, maximum is 5 years. If you look at the standard, they also recommend, because it is just impossible to see beyond that to any great clarity whatsoever. Okay? All right, so financial asset like receivables and stuff like that. Now, foreign exchange losses, gain or losses, like gain or losses from currency translation adjustments. So this also will be separately shown. Gain or losses from currency translation adjustment. Have you actually realized? No. You merely change the currency. And so you got a difference. So are you making money? So you must show separately. So if your functional currency is US dollars and your presentation currency is ringgit Malaysia, which you have to anyway. So all your transactions in Malaysia will be kept in US dollars because that is the currency of your primary economic environment in which you operate. You buy in US dollar, you sell in US dollars, the primary economic environment. So that is your currency. Okay, so at the end of the year, you have to retranslate that back into Malaysian ringgit. All right, so then what about the rules about transactions that took place at during the year are translated at the rate of exchange on the transaction date, but the retranslated amounts at the end of the year on outstanding balances are translated at the year-end rate. You know what I'm talking about now. Very good. So there will be translation difference which are not realized. So this will be shown separately, right? So example, finance cost, interest on borrowing, interest on lease liabilities. These are all finance costs. Total finance cost 50. Other gains or losses, show separately. Foreign exchange gain, 15,000. This is the others. Loss on disposal of equipment here. So net other gains, 10,000. All right. Now, I think I gave you one of your sheet there, the full layout of this. This is running in pages. Do you have it? It's one of your attachment there. I think it's there. I think the first one, isn't it? Ada? I'll go through that afterwards. Let me finish some of the slides here. So now I'm looking at something else called specific requirement for individual primary financial statement. Individual primary financial statements. Okay? Now, if you're talking about individual, that means individual company, statement presenting comprehensive income, totals must be shown. So for profit and loss, the profit or loss section includes all revenue, income, expenses, and losses recognized during the period, excluding items like under the OCI. All right, so these are what is required in the thing called individual primary financial statement. So the subtotal reflects the entity's net profit or loss for the reporting period before you add the other comprehensive income. So it is a key performance metric used for the users of financial statement. So that profit and loss section for an individual primary financial statement, all right, will be shown as net profit. Don't put in the OCI because that is the metric for the financial statement. So revenue, 1.5 million. Cost of sale, 1 million. Gross profit, 500,000. Operating expenses, 200,000. Finance cost, 550,000. Profit before tax, and then the tax expense, and that's the profit for the period. So this is presenting comprehensive income for individual financial. So you need to show the totals which are in yellow. Other comprehensive income, then you put the OCI section, presents item of income and expenditure that are not recognized in P&L, but they go direct to the statement of changes in equity. So they don't get recycled. For instance, if you have a long-term property, right, land, that you're using for your own office use, your factory is there, using for many, many years. Now you decide to sell that land. Or let's say you change your valuation methodology from cost to valuation because you want to give a more appropriate value to your balance sheet on your fixed asset. I'm not talking about the investment property. I'm talking about fixed asset. Normally, fixed asset you show at cost. Once you adopt valuation, you have to use valuation regularly. And the regular language in practice is about 3 years once. All right, so that is regularly. So now you have adopted. So therefore, when you adopted, you have gain on revaluation of your property. I mean, your factory, land and building. So every 3 years you revalue, there is an amount. It is not part of your operational profit and loss account. It's part of your OCI. So it goes into the OCI. Now, few years later, you sell that property. Now, before you sell, OCI in the statement of comprehensive income, where does it end up? It ends up in the statement of changes in equity. Remember? One of the columns in the statement of changes, revaluation of, a factory building. So it's in the statement of changes in equity. So few years later, you sell this building. You make a profit again. So there's no more building, gone. Cash flow will reflect sale of the building in the cash flow. Profit and loss account, got no profit. What happened? You made profit, but no profit. Why? Oh, that's because that is regarded in the olden day language as your capital gain. Now there's no such language. So the amount sitting on the column, revaluation of buildings, will be now transferred directly in the statement of changes in equity to the retained earnings within the statement of changes. It does not go to the P&L account. So profit and loss account, don't have. Statement of cash flow, got. Okay, now you see these are all differences here. All right. So let's look at this example. The OCI section presents items of income and expense that are not recognized in profit or loss, but are recognized directly in equity. That's why from the statement of equity goes into retained earnings. Under IFRS, MFRS 18, OCI must be split into two categories. We already have that. One is items that will be reclassified to P&L. These are temporary OCI items that will affect the profit and loss in the future year. So these are temporary, parked under OCI. When sold, it will go back to the P&L. The other ones parked in the OCI will go into straight in the statement of changes. All right, so we're talking about this. So let's look at the example. Items that will be classified: gain on losses of cash flow hedge. Cash flow hedging or hedging of any sort. There is a differences eventually will realize, and it will eventually go to P&L account. Exchange differences on translation of foreign operations. All right. So unrealized gain or losses on debt instrument classified as fair value through OCI. Debt instruments. Now, what is a debt instrument? A company is going to issue a bond to everybody. So you buy the bond. You are a company, you buy the bond, you are an investor in the bond. What would you show in your financial statement? Investment in quoted bonds. Let's say it's quoted up. What will be your valuation of the bond? Market value. Every year the market value, you will take the bond, right? Now, the issuer of the bond, the person who issued the bond, what is he going to show if he chooses the market value, fair value? If he chooses fair value of bonds, it's a liability, yeah? So if the market goes up, if you are the investor, if the market goes up, you got a gain. Floating gain, right? If the market goes down, you got a floating loss. What if the the company that issued the bond also fair value? So when the market goes up, you make a loss. When the market goes down, you make a profit. How does that work? And the old MFRS 9 said that's a way to do it. That is the way to do it. So if the investor is using fair value, when his share of the bond goes up, he makes a loss. So what does he do? The credit balance will have to go down. So when the credit balance goes down, it's because value going up or down. When the value goes down, he makes a profit. When the value goes up, he makes a loss. But you as the investor, when the value go up, you make a profit, bank makes a loss. What logic is this? So the IASB was asked this question. They say that you must take the same methodology used by the investor and the issuer. You cannot have a difference. So they stuck to it. So when there was the financial crisis, people who invested in Hong Kong and Shanghai Bank bonds in the UK and other countries, they had to show the gain or loss. But Hong Kong Bank had a loss when it's supposed to be a gain. When everybody was having a loss because of the financial crisis, Hong Kong Bank was having a huge gain in the P&L. Correctly done according to IASB. So when they revised the MFRS 9, they said, oh yeah, we totally agree, it makes no sense. So then they said, this is what happened. Unrealized gain on debt instruments that are issued will no longer go to P&L, go and park in OCI. Now only they realize after such a long time. Before that, when the issues were raised, they said, no, it should be the same basis. Right? So this is what it is. So items that will not be reclassified, these are permanent OCI items that remain in equity and do not subsequently affect profit or loss. Example, change in the revaluation surplus of property, plant, and equipment. This is what we talked about, right? Actuarial gain on defined benefit plan. What is a defined benefit plan? What is defined benefit? And what is a defined contribution plan? Actuarial? That's valuation. Huh? Okay, you are working in a company. Your employer is paying your EPF and you are paying your EPF. That is called a defined contribution plan. The contribution is fixed based on your salary. So it's called a defined contribution plan. So at the end of the day, you go to EPF and get the money. It could be very much more or less, whatever you have done, the interest, all this thing. So the benefit is not defined, but the contribution is defined. But in a defined benefit plan, okay, you take out an insurance, and therefore, if something happens, you are going to get 500,000. That is called a defined benefit, the benefit. Or people who work for a long time in a company. All right, let's say the company says, if you work for 30 years in a company, you will get a gratuity of 300,000, let's say. That is a defined benefit. So understand the difference between contribution and benefit. All right, so this one is on defined benefit is long term. You contribute long term. It's not a defined contribution plan. So it also is under OCI, permanent OCI. Unrealized gain on equity instrument classified as fair value through other comprehensive income. You will remember when you do financial reporting under financial instruments. So if you have some shares that you invest in, you can classify each item, all right, to be shown as OCI or through P&L account. And that is an irrevocable assessment once in the lifetime of that investment. So you can do many times. So all those that you do irrevocable and you don't want the profit to go to P&L, you want to go to OCI, then this is what it is. All right? Okay, items, example, we have already covered this. Let's go on this. Items that will not be reclassified. Okay, I think I have to repeat this slide here. Or I pressed twice. So illustrating example of OCI, other comprehensive income. Item that will be reclassified to profit or loss. Exchange difference on translation is reclassified. Gain on cash flow reclassified. Total is 7,000. All right, and then next one. Items that will not be reclassified, revaluation surplus 15 and actuarial gains 3, so total. So total other comprehensive income will be these two items here, all right, 7 and 18. You just have to show the two. All right, so comprehensive income in respect of total profit or loss and any other comprehensive income, it provides holistic view of entities' performance by including recurring and non-recurring gain or losses. So profit for the period, OCI, total comprehensive income, right? So allocation of OCI must be allocated between owners of the parent and NCI. So even when you're talking about OCI, you must allocate the OCI in a group account between the owners of the parent and the non-controlling interest, right? So let's look at this example. So example of allocation, OCI, total attributable to owners of the parent, 23, non-controlling 22, total OCI is 25. Next one, specific requirement also for individual on the statement of financial position. So current assets that are expected to be realized within 12 months of the entity's normal operating cycle, held primarily for trading. True or not? What if I give a loan to a subsidiary or a loan to a related company? Is it held primarily for trading? Then how come the statement says so? You see, you have some smart fellow asking this question. All right. Anyway, you don't have any other kind of current assets. Primarily for trading, not for trading. There isn't. So you have to put all together. Expected to be realized within 12 months after reporting date, and cash equivalent unrestricted. What do you mean by cash and cash equivalent unrestricted? What is cash and cash equivalent? You are showing a category of cash and cash equivalent on the primary financial statement. So I've got, let's say, I've got 1 million cash, bank. I also have fixed deposits, 3 fixed deposits. One is for 2 years, another one is for 1 year, and the other one short term. In case I don't need the money, I leave it there. Every 3 months, I extend. So what is my cash and cash equivalent? Does it include all or does it not include all? Huh? All. What did you say? Only those within 3 months. Any fixed deposit greater than 3 months under the standard, in the cash flow statement, it goes into investment. Even though you never intended to investment. Only 3 months, all right, readily convertible to cash. So even though 12 months is readily convertible to cash, anytime I can download it, sorry, it's not cash and cash equivalent. That's why you need to do a small reconciliation when you do the cash flow statement, you know. The balance in the balance sheet will not agree with the cash flow statement. Then you got to do a reconciliation on that difference. Okay? Although I'm not talking about that. Yes? Once is under lien, then it is definitely investment. Even 3 months under lien is investment. All right? It is still investment. It is your investment under lien. Just like it's your fixed asset charged to the bank. Yeah. Those are all simple charges. No problem. It's still your asset. It's charged only if it can be discharged. So just like you go to a bank and you take a loan, you got a factory building. Bank says, I will charge your factory building. I'll put a secure charge. It's still your factory building. What? You cannot say, oh, it doesn't belong to the bank. So your balance sheet, nothing. All it belongs to the bank. Yeah. So by same token, cash is yours. All right, it's yours. It's only you have to shade in the notes of the account. All right, there's a lien on the cash because of what. You have to state. Because I'll say, wow, this company got a lot of cash, man, quite good. Tied up. Oh. Many companies have, their fixed deposit used as security guarantee for contracts. Security guarantee. All right, so then that is a secured one. You cannot say, hey, I can actually cash out this. No, I'm liquid. No, you can't. Whatever guarantee, you must break that contract, then only you can do that. Oh, you mean the cash flow? This becomes restricted. Restricted, cannot tabli pakai. Definitely. In cash flow, it's called restricted. Okay? All right. So here you see cash and cash equivalent, unrestricted only. So current assets are those expected to be realized within the entity's normal 12 months, held primarily, expected to be realized in 12 months, and unrestricted cash flow. Illustrative example of each. So current asset realized in the normal operating cycle. Inventory, trade receivable, and other items consumed or sold during the ordinary course of business. Example, inventory of raw material used in manufacturing. You are expecting to turn over within 6 months, slow turnover. All right? And then trade receivable, customer due within 60 days. They are all realized in a normal operating cycle. Held primarily for trading, assets held or generated for resale. Example, financial asset like marketable securities actively traded in the market. Investment in quoted shares, all right? Merchandise inventory held by a retailer. So if you're holding the inventory, it is also, current. Realization is expected within 12 months. Assets that are not part of the normal operating operating cycle, but expected to be settled within 12 months. For example, prepaid expenses. I prepaid my rent for 12 months. So 1 year I don't need to pay rent. So even though it's 12 months, it's called normal operating cycle. All right? Annual insurance premium, more common. You pay your insurance premium annually, upfront. All right? But you're covered over the next 12 months. So this is also a normal operating cycle. Income tax receivables expected to be recovered within the next reporting period. Income tax got receivable. God, you overpaid the income tax. Expected to be recovered in the next reporting period. You sure? And it was for a short while. Now income tax says like this. If you want payment, they will pay you a small amount within 2 years. You want the full amount, 4 years. Yeah, there's a circular, from the IRB now. The repayment of income tax will take up to 4 years. You like a good person, I pay lah. I pay extra lah, so I don't get caught. But you wait, okay lah, you wait lah. You ask the tax department, 4 years time you pay. There is a circular, I'm not joking. So the moral of the story, pay your tax correctly. You pay little bit more, okay lah. Don't pay less. One less penalty, Immediately penalty. But you pay more, wait lah. You cannot set off. Next year you got tax to pay. You cannot set off against that. Hey, I got money inside. Cannot pay now. That one is that one. 4 years time we give you. Anyway, I'm not talking a joke. I saw the circular in my office because we are circulating around to our clients as well. All right, anyway, so income tax will be long term. I would say long-term receivable, no more in the next 12 months. All right. Cash and cash equivalent, unrestricted, cash on hand, demand deposits, and short-term, highly liquid investment convertible into cash with minimum risk. So short term. Cash in hand, bank deposits with a maturity of 3 months or less. 3 months or less. Non-current assets, all assets that do not meet the criteria for current assets become non-current. If you're not current, become non-current. Common sense. So PPE, intangible deferred tax asset. So deferred tax asset is deferred. So non-current. Long-term investment, long-term receivable. So non-current assets include PPE, intangible, and long-term investments. All right. Now, prescribed line item. So MFRS 18 specifies mandatory line items must be included. So these are the line items, which are not very far from the old one. PPE, investment property, intangible asset, biological asset, and financial asset, trade receivable, investment, inventory, cash and cash equivalent, deferred tax asset. Now, look at this. All right. They are under assets. And this is a deferred tax asset. All right. Then liability, trade and other payables, borrowings, provisions, deferred tax liability. Deferred tax liability. All right. And lease liability under MFRS 16. Equity is share capital and other components, non-controlling interest presented. So again, I've got one of the schedule. Later we will go through it. Right. Other sub-classification to be shown, MFRS 18 requires entities to provide sub-classification. So sub-classification will be trade and other receivable, break it up into trade and other receivable. All right? You need to break it up in the notes on the account. Otherwise, people say trade and other receivable. What is the other receivable? Oh, advances, deposits, etc. All right? Raw materials, inventory, raw material, work in progress, finished goods. This already in the existing one got. You got to break it up in the notes. Property, plant, and equipment, land and building is already in the, required to be done. Land must be separated from the building. So you buy a land and building. 1.5 million ringgit. How to separate? S&P agreement says land and buildings 1.5 million. Accountant come and ask you, hello, how to separate? They say must show land separately, pay another 10,000 value. But what you said is absolutely right. You must get the valuer to tell you how much is the land portion and how much is the valuer. Then, of course, value is a big name, no? Valuer. So they charge also like that. Yeah, it's always percentage. All right. So they tend to value a little bit higher, so more fees. Anyway, that's what it is, all right? You need to segregate. Anyway, the rule of thumb that some of the companies use, the smaller, is 2/3, 1/3. And that was given to us by a valuer. He said 2/3 is for the land, 1/3 is for the building. That's a ballpark figure. All right, that's a ballpark figure. All right. Then property, plant, equipment, machinery and depreciation, always we do it. Borrowings, short term, long term, don't mix up. Summary, the statement of financial position under MFRS 18 requires clarity and detail to ensure that stakeholders understand the financial health. So proper classification, current versus non-current liabilities, mandatory line items, and all the sub-classification must then be shown according to this standard now, right? So statement of changes in equity, what do you show? Total comprehensive income for the period. The statement of changes must show total comprehensive income separating amount attributable to the owners of the parent and the amount attributable to NCI. We always do that, so nothing new on this, all right? So another example, we will look at it afterwards. Retrospective application or restatement in the statement. If there's a retrospective application of a new accounting policy or a restatement impact on the equity component must be shown separately. Example, retrospective adoption of IFRS 15 resulted in a restatement that increased retained earnings by 50,000 at the beginning of the period. So you need to show it separately. Reconciliation between beginning and end balance, this we always show. So opening balance at the beginning of the period, movements during the period, including OCI, and closing balance. So we will look at all this at the various appendices that we have there, all right? Changes must be disclosed separately. Separate disclosure for changes resulting from profit or loss. That means include net income attributable owners and NCI. Retained earnings increase due to profit for the period. All right? So definitely we show retained earnings in the statement of changes in equity. Other comprehensive income includes items not recognized in P&L but directly in equity, like revaluation surplus. All right? Foreign currency translation adjustments. Transactions with owners, contributions, issuance of shares, that means money coming in, and capital contribution. Distribution is money going out, dividends paid to shareholders, changes in ownership, all right? Transactions like acquiring and selling shares in the subsidiary that do not result in a loss of control. You own 60%, you own 80% of the shares, you sell off 20%, you still got 60%. So it's a sale of shares that does not result in a loss of control. All right, and that example now. So we got to stop now for your tea break. So eat again. So here are the appendices. All right, so where you can see the full, because on the slide it is cut short here and there. So here you can see the full one. I don't think I'll go through in detail with you, like statement of changes in equity. You can see all the, how it should be shown under the MFRS 18. Of course, some are similar, some are not similar. But you can go through this as you're working, as also as the, training for the students eventually. So this is the comprehensive illustration on the whole notes on the accounts. Okay. So I'll make this bigger so that you can have a look at it. All right, so all these are the subtotals where you need to put it. There's an example here. So it's quite comprehensive. You can look at it. And here I have a new standard for revamping financial performance. So it's I compiled it for this one, introduction and then the statement and all this stuff here. So I compiled it into a sort of a small summary which we went through this morning, all right? So here's another one, MPM reconciliation. This is a learning objective to help participants understand how to interpret a management-defined performance measure. We talked about it just now, all right? Maybe we will do this now, all right? Just because I think time is running very short. I think having a practical session, to understand an example is better than the theory. I think you know the theory quite a lot. So here, we are trying to interpret what is a management-defined performance measure, MPM, all right, this one. Management-defined performance measure. So let's see what is here. So the background scenario of this imaginary company, Brightview Berhad, is a technology services company listed on Bursa Malaysia. It's in its 2024 earnings presentation, the CEO highlights the company's strong operational performance and presents the management-defined performance measure called adjusted EBITDA. So they came up with this adjusted earnings before interest, tax, depreciation, amortization, and they said the amount is 31.2 million. So the company provided the following details in its public communication and P&L extract. So they put their item, all right? Revenue 440 million, cost of sale 95 million, gross profit 45 million, selling and distribution expenses 4.5, and of course administrative 10.5, R&D expenditure, amortized development costs 2.0, depreciation, PPE, amortization, impairment loss, and recurring restructuring, one-off restructuring costs, giving an operating profit of 20.7 million. These are all rounded up figures. If you add, there'll be some different. So they came up with adjusted EBITDA of 31.2 million. This is the figures that are given officially, but they also came up with management performance, all right, measurement, and that is EBITDA 31.2. So management explained, adjusted for non-cash charges and one-time restructuring items to reflect core operational performance. All right, so they're saying we have adjusted the EBITDA, which would have been different here, but it's adjusted because of the one-time changes. All right, so the exercise to be done, as I said here, reconstruct the reconciliation from the adjusted EBITDA to the operating profit. Reconstruct from 31 million to 20.7. All right. Identify which items were likely adjusted in the MPM, whether, all right, the MPM presentation is consistent with MFRS 18 requirements. Is there any risk of cherry picking? Did they select what they want to show and don't select what they don't want to show? That's called cherry picking. All right. So we are not going to discuss in small group. I'm going to go through with this, all right, on the debriefing here. So reconciliation of the adjusted EBITDA to the operating profit. So their adjusted EBITDA given, all right, is actually 31.2 million. That's what they said, right? So now we're going to reconcile. So starting with 31.2 million, so they had depreciation on the PPE, they adjusted this, 3.5 million, all right? And also amortization of the intangible, 1 million, impairment of trade losses, all right? Trade receivables, to 0.8 million, and restructuring costs, one-off, 2 million. So they came up with 20.7 million. I think there's a small error there, but the small one. So are these adjustments to reach the adjusted EBITDA of 31 reasonable and transparent? Should the impairment loss that we put here, impairment loss, which is 0.8, be excluded from the management's figures? If this MPM is disclosed in the financial statement, what else should be included under the MFRS 18? All right? So the answer to that, I will give it to you. I don't think you have the answer. Maybe it's there. I'm not sure. No, this is the one I gave you. Wait, let me look at to give you the answer first. All right, here we are. Items which were likely to be adjusted in the MPM. Items adjusted to derive the EBITDA of 31.2 million. Depreciation was 3.5. Amortization for 1.0. Impairment losses 0.8. And restructuring 2.0. But if you add all this up, that only totals to 28.0 million when added to the operating profit of 20.7 million that you saw in the P&L 27. If you adjust it, it comes only to 28 million. Where is the difference? So there's a discrepancy about 3.2 million, rounded figures, that has not been explained. So here again, and this is what you need to understand. Sometimes people don't give the full figure. So is the MPM presentation consistent with MFRS 18? Is partially consistent. Why? Because labeled and explained in general terms. No detailed reconciliation provided. All right, that must be provided. No disclosure of tax or NCI impact if applicable, but nothing here was stated. Unexplained difference of 3.2 million, this 3.2 million here, all right, indicates that it's an incomplete compliance with MFRS 18. So the entity's disclosure, as it's shown here, will not actually satisfy MFRS 18's full requirements. So is there a risk of cherry picking? Yes, the following are the potential red flags. Why? Adjustment for impairment loss, not for the potential favorable one-off item. So they want to exclude the one-off item, all right? And also inconsistent application of non-recurring label. So anything that's non-recurring, sometimes you include if it's a gain, sometimes you exclude if it is a loss. So the non-recurring, if you include, it's always all the way non-recurring, you must include. But sometimes they include when it's a gain because it shows a better figure, but when it's a loss, they don't want to show, if it's an expense, they don't want to show the non-recurring, all right? So incomplete reconciliation may indicate selective presentation. You reconcile, but not in full, all right? And that will be like selective presentation. Such practices could mislead the user if not properly disclosed, all right? And the next one, let's look at a draft reconciliation, a note. We put as note XX, whatever it is. Management defined performance measure, adjusted EBITDA. So adjusted EBITDA is a non-IFRS management defined performance measure used by this company, Brightview Berhad, to assess the operating performance before the effects of non-cash and non-recurring expenses. Management believes this measure provides users with a clearer view. Now, so here I've done that reconciliation. So description, EBITDA as communicated externally in the financial statement, 31.2. Less depreciation of property, plant, equipment, 3.5. All right, less amortization of intangible asset, 1.0. Less impairment loss on trade receivable, 0.8. One-time restructuring cost, 2.0. So therefore, the operating profit as per the statement of profit and loss should be 23.9. All right? So the P&L reports operating profit of 20.7. So between 20.7 and 23.9, there is a 3.2 million difference that must be explained, which is not explained by this particular account. So you'll know that this is not correctly done. All right? Then the note, the P&L reports operating profit 20 and 3.2, it must be explained. Now, the tax and the NCI effect. There is no holding and subsidiary relationship, so there's no NCI. So it's not applicable here. If it is, you must show it. Consistency statement. The MPM is presented on a consistent basis. This is their notes, with the prior period. Any changes to the calculation or rationale will be disclosed with justification. So the point to note here, probing questions that we need to ask. All right? If you were an investor, would this MPM be helpful or be potentially misleading, telling you that our EBITDA is actually 31.2 and not 23.9? Will it be misleading? Right. Okay. To emphasize, the reconciliation is not optional. All right, reconciliation is not an option. It is a required disclosure under MFRS 18 to combat misuse of alternative performance measure. So this is the alternative performance. I'll give you as an example. You have this? All right. So I'll close this off and I'll come back to, this is, I think you already have this. So I'll close that as well. And we'll go and finish up the slides, all right? So I'll go very quickly on the balance of the slides, which is actually disclosure. So let's carry on, because immediately after that, the thunder is also coming. And immediately after that, we're going to have a small little quiz. So you're going to answer questions. Those who cannot answer will stay back. All right? Okay. Let me finish this. So we were talking about, I'm supposed to stand in a certain place. So I finished on the Appendix 7, which is on your file. The Appendix 7 is on your file. So now let's look at the statement of changes in equity, a summary. All right, the statement of changes is a vital report that details movements in the equity during the period. You want to know what's the opening, where the money came from, or it came from new share capital, or it came from any other preference share capital. All right, how much was paid out as dividend? Did you have the money to pay out in terms of, are you using the new share capital came in cash to pay out as dividends? What will be the effect of, how total comprehensive income is attributed? The effect of retrospective adjustment, because retrospective will adjust the retained earnings. How is that affecting it? A clear reconciliation of the equity component with detailed disclosure of changes is necessary under the new MFRS 18. The notes provide additional information essential to the understanding of the financial statement. That explanation supports the primary financial statement and gives a detailed breakdown and clarification as well. It presents information about events, about trends, about risk. Events that are occurring in the company that are unusual. It also talks about trends that are occurring in the industry, and also about risks that are undertaken by the company or they are forced to undertake whenever there are risks that appear. So, notes to the financial statement, you need to show this. All right, these are all the requirements for individual primary financial statement. So, entity must disclose basis of preparation, comply with MFRS, IFRS, or whatever it is. Measurement basis, historical cost or fair value. Presentation currency, we all already do this. So this is nothing new. All right, so example, illustration. The financial statement have been prepared in accordance with Malaysian Financial Reporting Standards, the International Financial Reporting Standards, and the Companies Act 2016. In Malaysia, we must use the word Companies Act 2016. It's required. Internationally, you don't put the Companies Act, you might put other legislation. All right, this is a mandatory requirement in Malaysia on the basis of preparation. So these financial statements are presented in Malaysian ringgit, rounded to the nearest 1,000. If they are very big, you round to the nearest 1,000. Unless otherwise stated. The financial statement have been prepared on the historical cost basis, except for, what happened? Except for financial assets, which are classified at fair value through profit or loss. That's fair value through profit or loss. Property, plant, and equipment that are valued at the revalued amount. Biological assets that are valued at fair value. Also, accounting policy used. The notes include a summary of significant accounting policy applied in the preparation of the financial statements. All right. For each material item, the following should be disclosed. Recognition and measurement criteria. As you know that for every item, there are altogether how many items that you need to understand in a standard? All right. First, recognize, measure. All right. Present and disclose. How you recognize an item. All right. How you measure that item. So is this supposed to be a financial asset or a non-current asset? Financial asset is how you identify. Then how do you measure? How do you measure the financial asset? Fair value, or are you going to use at cost? And then how do you present it? Is it a separate item on the face of the balance sheet, or is it to be grouped together? And then the disclosure in the notes on the account. So always remember, all right, you need to put all these four for any kind. And anyway, all standards are written in that fashion. All right? So, recognition, measurement, presentation, and disclosure. So, judgments and assumptions used Sometimes you want to arrive at a figure, there are certain assumptions. Fair value has assumptions, all right? Judgment has assumption. Depreciation is an assumption. Assumption of the useful life of the asset. How do you know the useful life of the asset? Can you just leave depreciation of asset? Oh, this one 10 years. So for the next 10 years, you just calculate depreciation when already the asset in the factory there is already condemned. I've seen so many of this. People are calculating depreciation with a calculator. Go down to the factory floor. Hey, you talk to the machine operator. He say, any machine should have already condemned. I told the boss to change, never change. You see, I'm not sleeping. The machine not running. The spare part don't have. The motor burn out so many times. There in the accounts, no, it can last another 5 more years. It's very good. Yeah. You see, that's called the total mismatch. That's why sometimes the people doing the accounts are not in touch with the reality of the situation. What is it? But they do account because they need to do accounts. And this is what you have to emphasize to all people who are doing financial. Don't be simply looking at the numbers. They mean absolutely nothing. You have to go down and see, because it's a combination of this that makes the financial statement meaningful. All right, not just taking the numbers on the face of it. I always go down to the factory floor, into the, if it's a plantation or what, get my hands all dirty. But the thing is, I learn a lot of things during that process. And I know exactly what it is. Otherwise, people say, oh, like that, like that, like that. You do a housing development project, I got to go to the project with a map there, how many percent complete, this batch, this one, how many percent. Now we use drone to see the overall, to make the map is correct. Nowadays, a lot of new things are carrying on, right? All right. Next one. Summary of significant policy, revenue recognition. Revenue is recognized when the control of goods is transferred to the customer, measured at fair value at the consideration received. Fair value is the consideration received or receivable. Specific revenue include sale of goods recognized at the point of delivery, and service revenue recognized over time. So I sell you a machine with 2 years service free or 2 years service. So when I sell you the machine, the person buys the machine. So I'm the seller. That's more important. To me, it's the revenue from the sale of machine. The sale of machine includes 2 years of service. So I got to use what they call the comparison method. If I sell the machine without the service, how much will it be? If I sell the service separately, how much will be? Using that method, we determine how much is the service portion, how much the machinery portion, then we depreciate the machinery. Or rather, we take up the machinery sale. But the service cannot be taken up because you are giving over 2 years. So you got to account. So you got to explain how you arrive at that, recognized as they are rendered. All right, you can't take up the income and start giving the service. Enron did that, okay, which was wrong. So property, plant, equipment are stated at the revalued amounts, which represents fair value at the date of revaluation, less accumulated depreciation and impairment losses. So even though you revalue, you still depreciate, all right? Like property, plant, equipment, you must depreciate. Financial instruments are classified as valued, as measured at amortized cost or fair value through OCI. Fair value through profit or loss, or fair value to OCI, depending on the business model. The business model is described in MFRS 9 or IFRS 9. All right, for managing them and the contractual cash flow characteristic. So contractual cash flow is, does the instrument give you a contractual cash flow? It means when a bond, it will pay you interest at specified interval. You invest in share, there is no contractual cash flow. So share cannot be classified as such. So this includes subtotal breakdown, additional disclosure required by MFRS, but impracticable to present directly in the financial statement, too cluttering. Show it in the notes. Example, breakdown of revenue under MFRS 15. Disaggregate revenue by category, product type, and geography where. Financial instrument, break down fair value hierarchy. This is level 1 fair value, open market value. Level 2 similar item. Level 3 is a calculated version. All right, that means you are doing like a projection and coming to a figure. So that's level 3. And then revenue is disaggregated. Product A, 1.2 million. Product B, 800,000. Service revenue, 500,000. So this is information required by MFRS, not presented in the primary listing. So you have to show it in the actual notes. So service revenue, 500,000. Total revenue, 2.5. So you break it down in the notes. Under MFRS 15, this is how it is. So the following table on financial instrument provide an analysis of the financial instrument by measurement category at 31st December. Financial asset measured at amortized cost. Show it separately from those measured at fair value through profit and loss account and from those financial liability measured at amortized cost. These are in the notes, right? Other information not present in the primary financial statement but in the notes. This section includes disclosure of significant events, trends, or contracts that impact the entity's operation. So what are the significant events that occurred after the reporting date? We already do it, but now they are making sure we do it. Because events after the operating date, if it's a significant, investor wants to know. Your whole factory burned down already after this thing. People say, hey, good company, good. Actually, no insurance also, everything comes to a stop. People look, hey, good man, I think I better invest. You see, you don't know what's happening. Or there's a potential litigation against the company, which when successful, the company will become bankrupt because it's so huge. If and when it's successful, it is a contingent liability, contingent upon the happening of the judge passing the judgment. So these have to be also stated, all right? And then risks and uncertainty, contingent and commitments, environmental, economic and uncertainty. So that's why like Trump effect on certain companies, under MFRS 18, you got to see what's the potential effect of the tariffs on your exports to the US. How much of your exports are to the US? How much are to other countries that also have tariffs? So you have to explain this. You not show it in the notes. You won't show it in the main account, but you show it there so people know the effect, right? So long-term contracts, joint venture, and major customer dependency. So another example, significant events and trends. Now, we are looking COVID. You'll be thinking, hey, hello, COVID came in 2020 and disappeared. All right? Really? Is it? The residual and the runoff effects are felt even to today in a different way. So you cannot say, oh, COVID finished. No, that's not the right way. So let's have a look. The ongoing COVID pandemic continues to affect the global economy. The group has implemented measures to manage risks, including cost reduction initiative, diversifying the supply chain. Revenue declined by 10% in the first half of 2024, but recovered in the second half. Now, COVID has a lot of things, like people still invest in PPE, not property plant equipment, protective personal equipment. All right, so you have a different expenditure there. All right, sometimes you need to have people work from home. You need to give them the equipment. So there's costs that are still being incurred today, which is the result of a COVID that came and went. Okay, like a planet that came and passed and went. So, major contract, another significant event. The group entered into a 5-year supply contract with XYZ Limited, valued at 10 million, effective 1st January 2024. 5-year supply contract. So you are talking about a major contract. This is a good thing. So whether it's good or whether it's bad, it's up to the investor to decide, oh, you got a good contract. But now with all this uncertainty here, how is your contract going to go? Let the investor or the stakeholder decide. But you still have to give it, right? Contingent liability. The group is defendant in a legal case related to product liability claim. The estimated exposure is 500,000, which management believes is not probable and has not been recognized. So I like this story always. Management always believes that it will not eventuate or it will never realize. but 90% of the time it realizes. All right? Yes, it's not a joke. I myself was handling a client who was actually having a dispute with the landlord, not the landlord, with the person who rented the property. It's a multi-story building. They rented it for 30 years. All right, at a rental of about, if I'm not mistaken, it's very big, so it's about 600,000 per month. So one year about 7-8 million ringgit. So the rental was supposed to go up after 10 years in incremental stages. Now, when the COVID hit them, okay, everybody was not renting already. So the rental came to practically very low, but there was still rental. So they wanted to speak to the directors of this company to ask for a reduction. But that time we are still in the midst of COVID, so people weren't traveling. So the directors say we will have to find a day to decide and wait. But before they could do that, the other party terminated the contract. But the agreement is very clear. You cannot terminate. So terminate. So then, of course, these two directors decided, okay, we are going to take action against you for terminating, which means you must pay the rental for the next 15 years. All right? 7 million per year, 15 years. Now, if you want to terminate the contract. So the other party, which is the public listed company, said, all right, we go for arbitration. So we had to pay the upfront arbitration fee, 2.3 million before you talk. They give letters, so gave. So after that, in the accounts of that public listed company, which I happened also to read, contingent liability, all right? The company has a contingent liability relating to so much. The directors are of the opinion that this will not eventuate. So they're telling you, no, it will not happen. So it really did not happen. You know why? They negotiated back and say, okay, we'll carry on. We'll pay the back rental for that 1 year we didn't pay, and we carry on. So that court case never went to court. The arbitration never went, and they are still renting the property. They paid some compensation. You see, so sometimes the note on the account never tell you, and it's not audited by a, what the Mutu, Atong and Ali kind of accountant. It's one of the big four. Right? All right, anyway. But definitely because they know they will lose. Because it's so clear in the agreement anyway. All right, so this is a defendant legal case related product liability. The estimated exposure is 500,000. Management believes not probable and not being recognized. But at least you put in the notes. Let people decide. But when you put like that, you're skewing their thought. Oh, I think it won't happen. I think it won't happen. Sometimes the lawyers have stated that we have a good chance of winning. We have a good chance of winning means, don't know lah. We might lose the case lah. So this is all you must read into the meaning. Okay. So the group has a capital commitment of 2 million for the construction of a new warehouse expected to be completed by quarter of 2025. Here I put it in Appendix 8. All right. Contingent liabilities group this one is the same. Sorry, this is a repeat. Oh, that's all. We have come to the end of today. All right, so now, any questions? Or forever hold your peace. I'm going to put you into the question mode. Now, all those who can't answer, stand outside there. No. Stand along. All right. I'm going to do this round all the tables. There are 1, 2, 3, 4, 5 tables. So there will be excellent for 2 rounds of questions. Each table answer, the person who answered the question who wrong, you either stand there or crawl under the table and hide until finish. All right. So you decide who to answer. I'm not going to ask you in each table who answer. You're going to fight among yourself. So the first question is, what is the main reason for replacing MFRS 101 with MFRS? I didn't ask you. I didn't ask you. I choose. Oh, you want them to answer? Okay, wait, I haven't finished the question also, man. No, you already want the answer. So choose the most applicable answer. All right? To introduce a cash-based reporting model. B, to reduce the number of financial statements. Make it less long. Huh? C, to enhance communication of the financial performance and comparability. To replace the concept of accrual accounting. All right, first table, that one. Who is going to answer? Yeah. Okay, C is correct. So you, who answered?
The person who answered me.
No, all said no, only one representative. Otherwise, you're going to. Otherwise, you got to cut up the present and show. All right, question number 2. Don't worry, you got some more. You got only five there. All right, number 2. Which of the following required a subtotal under MFRS 18? EBITDA, A. Operating profit, B. C is gross profit. D is profit before tax. Which is the one? I didn't ask you. I didn't ask you. You answered too many times. No, I'm not asking you, so no present for you. Okay, this table. B, correct. B is correct. Who answered? Somebody answered there. Put in the table. All right, next one. Number 3, are you ready? Don't answer. Huh? You answer, I'm not asking you anymore. I won't ask you. That one is for other people. All right, which of the following best describes management defined performance measure MPM? A, all right, an IFRS defined subtotal included in the income statement. B, any KPI used for internal budgeting purposes only. C, any non-IFRS performance measure disclosed in the notes with reconciliation. Or D, a ratio disclosed only in the MD and A section. Which one? Now, suddenly all quiet. Okay, this table. You. Answer. Correct. I think the question too simple. Next time around, I'm going to make more difficult. All same question, same answer type. All right, number 4. What must a company and MPM disclose under MFRS 18? The auditor's certification, a statement of changes in equity, a reconciliation to the most comparable IFRS defined subtotal, or do you need to disclose a cash flow statement? I didn't ask you. Okay. That table. What did I say?
C.
Okay, correct. C is correct. Number 5. All right, number 5. Under MFRS 18, which of the following would be likely to qualify as an unusual item? All right? An unusual annual salary increase. Unusual. Don't expect. Why couldn't it be? Company never gives salary, suddenly give one. Unusual. Now B, gain on foreign currency translation. All right? C, one-time legal expense from a major lawsuit. D, depreciation on new machinery. Which one? You. Oh. What did you say? I thought I heard D. Okay, very good. So we still have 5 more, but there's no present. So this time we're going to ridicule whoever cannot answer. All right. Number 6, but no more present, huh? But this time going under the table. Oh, still God. Oh, other. Still God. Now better than just now one. Got money inside? God. A lot. A roll up one, All right. Which of the following is not one of the 5 mandatory categories for income and expense classification? Operating, investment, financing, income taxes. Are you sure? Just now I talked about income tax, what? Investment, operating, investment, financing. Why is income tax not a mandatory category? I think you were sleeping at that time. Must be a bit sleepy lah. Must be after the lunch lah. Fell asleep. Or after C then can correct B. Your exam you let your students change like that ah. Okay, that table. Wrong. Take back. Wrong. Yes. B is the answer. So I've given the answer. So there's. You didn't answer B, did you? I didn't ask you. So we got 1 bonus prize now. Not yet. You must be patient. Number 7. When presenting expenses by function under MFRS 18, what must be disclosed in the notes? A full reconciliation of the cash flow. B, a breakdown of expenses by nature. C, the historical basis of depreciation. And D, the tax impact of each expense. I read the question again. Huh? When presenting expenses by function under MFRS 18, what must be disclosed in the notes? Is it a full reconciliation of the cash flow? Is it a breakdown of the expenses by nature? Is it a historical basis of depreciation? Or tax impact of each expense? Now your answer. What the answer? I didn't hear. Don't put up your hand and get it.
B.
Sure or not?
Very sure. 100%. Positive.
Wow. Phew.
Not challenge.
Okay lah. I give chance lah. Yeah, it's correct. Answer is correct. Because you give a breakdown of the expenses, right? All right. Next one. Number 8. Wait, you must take photograph. You're coming on the newspaper tomorrow. All right. How should interest, number 8, how should interest paid generally be classified under MFRS 18? Always shown as operating expenditure? Always financing? Based on the nature of the related liability? Or must be excluded from the statement? All right. Number 8, what is the answer? Sure not. You don't want to lose again, huh? You answer already. Okay, this table.
Answer is C.
Answer is C. Yes, answer is C. The table already got 2 gifts already, what? Greedy. Okay. Next one. Number 9. What is the transitional requirement under MFRS 18 for the first time adoption? Do you take a prospective application forward, apply from the date of approval by the board, B, retrospective application with limited exemptions, or there is no requirement, all right, for restatement of any of the comparative? Okay. I give everybody a chance lah. All right. And finally, number 10. Answer is there already. Okay. So, which of the following statements should about MPM is true? Your answer is there already. MPM replaced MFRS, IFRS defined subtotals in financial statement. Do they replace it? And MPM is optional and do not require any disclosure. Number B. C is MPM must be labeled clearly and reconciled if disclosed. All right. And MPMs are typically used only in private company reporting. Which of the above is true? Who hasn't got the answer yet?
No.
The answer is C.
Yeah, correct. C. So there is a bonus. Bonus question. God. Huh? Oh, why? They go one only. Oh, so the table didn't get any present. So I'm going to ask a question which is not anywhere around this thing here. So, when is the adoption date for MFRS 18? I give you the option first.
1st January 2027.
Yes, correct. Okay, so that's been quite an enjoyable session today. I hope you learned as much as you could. And thank you for the questions. And thank you for the participation today. So I'll see you some other time. Thank you very much. I'll hand this back. Thank you. Thank you.